This is Bloomberg Surveillance. I'm Karina Mitchell with the Bloomberg Business Flash. Shares of AstraZeneca sank to an 8-month low today. The drug maker has agreed to buy Alexion Pharmaceuticals for $39 billion in cash and stock. That's a 45% premium to Alexion's closing price Friday. The company specializes in immunology and treatments for rare diseases. And it is one of the largest regional bank mergers in the U.S. this year. Huntington Bank shares will acquire TCF Financial in a deal valued at almost $6 billion. That represents an 11% premium to TCF's close Friday. Huntington operates a network with 839 branches across 7 Midwest states. And the battle between mutual funds and exchange-traded funds has turned one-sided this year. Roughly $427 billion has flowed into U.S. ETFs in 2020. At the same time, mutual funds have lost $469 billion in assets. That's on track for the worst year on record in data going back to 1990. And Deutsche Bank may eventually allow some of its 4,600 employees in New York City to move elsewhere. The German lender is preparing to move operations to the Time Warner Center in Manhattan. It's discussing how to allow more employees to work from home and from other locations. And that is the Bloomberg Business Flash. Francine.
Thank you so much, Karina. Now, this is what we're looking at, European equities, and we're also getting some headlines out of Brexit. Now, we did hear Michel Barnier briefing envoys that actually they're very close to a deal, or Michel Barnier told a private meeting of ambassadors that a trade deal with the UK could be completed as soon as this week. And now we're hearing also from the Irish foreign minister that everything is done except for fisheries and the level playing field. So there are gaps that still remain, but actually we seem closer to a deal certainly than we were on Friday. So on European equities, they're extending last week's, volatility actually in certain parts, but overall there does seem to be positive news out there. The narrative is on the Brexit relief and also on these vaccine rollouts, and they're offsetting some renewed virus restrictions and concern about the number of infected. So just look out for the European Stoxx 600. You can see gaining some 1%, and then euro, pound, the one that the pros watch for, if you believe Tom Keene, and it's at 90.52, Lisa.
Yeah, you can see the same kind of risk-on feel across the pond over the United States. S&P futures gaining steam as we get closer to the open here at 9:30 a.m. New York time, up 0.7%. Meanwhile, the Russell 2000 is what I'm watching off earlier highs, but futures up nearly 8% to 1928. Really interesting to see how the cyclical shares, these small cap stocks, have outperformed dramatically, returning almost twice as much as larger cap stocks since the end of October. The interesting thing, Francine, to me is you are not seeing bonds participate in this rally. Yes, you are seeing 10-year yields edge up just a bit higher to 92 basis points, but not going gangbusters by any means. We're still looking at a 10-year yield below 1% here. And then gold, you all are also off. And I will say, Francine, there is this feeling the Federal Reserve will have to eventually come back and buy longer dated bonds. Francine.
Yeah, we'll have plenty more, of course, on the markets. Also coming up, we speak to the Democratic House Representative Dwight Evans from West Philadelphia. We'll talk about politics. We'll talk about trade. We'll talk about vote counting. That's coming up shortly. And this is Bloomberg.
give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel. This is Bloomberg Surveillance. I'm Lisa Abramowitz in New York, Francine Lacroix in London, Tom Keene off getting a tree. Vet bill is very particular. Joining us now, we really want to focus on that $908 billion bipartisan proposal we are supposedly going to be getting today from Washington, D.C. to try to support the economy. Representative of Pennsylvania's 3rd District, Congressman Dwight Evans, joining us now. Congressman, you have been vocal about the need to pass this bill, and we certainly talk about the differences between the Democrats and the Republicans, given the fact that we have the issue of $160 billion going to state and local governments, and also the liability restrictions around COVID being the main sticking points. Do you think the Democrats should just agree at this point to sign off on the rest of the $748 billion plan and leave these other issues to next year in order to get money to the people who need it the quickest possible?
Well, the reason I've been so bold about it is because the chairman of the Federal Reserve said that we need to go big and bold if we want to move this economy. And I think it's very clear that it's not something that we can take for granted. And I believe it takes a bipartisan effort in order to make it happen. I believe that at this particular point, with all the pain that is out there in terms of housing, job benefits, direct payment, those kind of things, we can work it out. I believe that this is just a bridge to when President-elect Biden becomes president next year, because there will be an additional stimulus. So in my view, we need to do what we need to do now. You've heard President-elect Biden. He has come out publicly and said that this deal needs to get done, and we should take that action.
We need to do what we need to do now. What exactly is that in terms of dollar amounts, in terms of where the money goes?
Well, I think that basically in the range that you just described, $980 billion is a start. I think the fact of the matter, direct payments, small businesses, we need to address, state and local government need to address, and there's even the discussion about liability protection on the table. I think all those things on the table, we can work it out. I don't think anything is that difficult that we cannot fix it. It is in our interest. Look, we have had a very tough year. And the reality of it is President-elect Biden said that really this is about the virus and not beating up on each other. So we need to keep that in mind. With a brand new president coming in as of January 20th, the reality is that we need to work together. That's the only way we're going to move this economy.
Congressman, you're also on the Committee for Small Businesses. How many small businesses will go under in 2021 because of the pandemic?
That is, I mean, I can tell you here in the city of Philadelphia, you're talking about in the range of 30 or 40% that you have businesses that will never maybe come back again. And the reality is those people are struggling. They are looking for avenues, looking for lifelines, and particularly businesses that are in the minority community. It is very clear that what is happening there because of the fact that the accessibility to capital. This is something that they're really concerned about. We should be concerned about because there's a connection to jobs and employment. We need to understand that though, look, this pandemic is not the fault of any particular party. It's the question of how we manage it. And the reality is right now we had an election. The election is over. It is now time to get to work. And all of us to recognize that we got to work together in order to solve this challenge like we have had in over 100 years.
But Congressman, 30 to 40% is huge, right? Is there anything that those small businesses would be asking of you now? Is it too late to salvage at least part of them?
I believe it is. I believe it's the urgency. There has to be a sense of urgency in the passage of this relief package. You know, we really should have passed this back on Thanksgiving. Here we're about a week away from Christmas. And clearly these businesses could have been taking advantage of opportunities. And right now they don't have those opportunities available. So I've been one of those strong advocates about the leadership, particularly the Senate leadership, to come to the table and get serious about it. Let's solve it. Let's stop this back and forth. You know, we got to pass this. We got to pass the CER. So we got both. We got to the end of the week on Friday to pass this and bring it together. So I share with you that I think we're in the position to do it. We just have to do it.
So, Congressman, you were talking about how any gap or any measure currently passed in Washington would be a stopgap measure until next year when additional rounds of perhaps even stimulus and not just stopgap funding would be passed. What are the priorities of Congress, given the fact that Democrats have less of a majority and that the leadership over in the Senate is still undetermined?
I believe we should start off something that we all probably could relate to, something that the current president talked a lot about: infrastructure. This House.
We seem to have be having issues with Congressman Dwight Evans. Thank you so much. We appreciate you taking the time. Really interesting, Francine, to see how there is this split feeling in Democrat parties as well as within the Republicans in terms of what to concede in order to get something done. The need is serious. Today, New York City is going to halt all indoor dining for restaurants. The pandemic not over yet, Francine.
Yeah, and we heard there from the congressman, it's the small businesses that suffer the most, and he was actually for a very long time pressuring for these targeted coronavirus relief bill, growing more and more as time dwindles. I think we have the congressman back, so I don't know, Dwight Evans, if you can still hear us.
Yes, I can hear you. Yes, I can hear you.
Technology hit. It's very 2020. Time is dwindling. If we don't have anything by this week, how much of a disappointment will this be for you and small businesses and restaurant owners and others that really need the money?
It would be very disappointing to me. I don't think we should leave until we get a relief package. We have a commitment to the American people, and we should make that commitment and fulfill our job and our responsibility. So this impact that I'm describing to you, particularly with small businesses, will affect all of the communities across the United States. And kind of that ripple effect, as the Federal Reserve Chairman talks about in terms of our economy, about recession, that is clearly a message. Eviction of individuals out of houses, all those things work in bond. We're at a point now where we can do better. As the president-elect says, we can build a better America. And the reality is, the way we can build it is by working together. That is the most essential part. We should not take that for granted. So I'm doing everything I can humanly possibly do to stress the message for the sake of for the people and get this done.
So, Congressman, just to wrap things up, when you talk about priorities for next year, I do wonder, when we talk about big tech and the importance of technological advancements, there's also a question of squelching competition with some of the big tech names. Is that a priority for your Democratic colleagues to try to rein in some of the expansion of big tech?
Well, that would be one of the issues on the table. As I mentioned earlier, I talked about infrastructure. I talked about roads, bridges, waterways, Wi-Fi, all those things. If you're talking about growing the economy, you need to talk about investing in the infrastructure. The reality is we didn't do infrastructure in the last 4 years. Infrastructure has normally not been something that is partisan. So ways and means, transportation, infrastructure, those are the areas that so infrastructure is something we shouldn't take lightly. I believe infrastructure is something that could pass, is not partisan. It is in the interest of the country to pass infrastructure. I think that should be number one.
Congressman Dwight Evans, thank you so much for being with us. And I will just say, Francine, we've been hearing about Infrastructure Week for about 10 years, and it seems like a bipartisan agreement, yet they can't get it together. So maybe 2021 will be the year. Let's get to the Bloomberg First Word News. Here's Karina Mitchell. Karina.
Lisa, thank you. Healthcare workers and nursing home residents will be first in line when U.S. hospitals begin giving coronavirus vaccine shots. The first 2.9 million doses arrive at more than 600 hospitals over the next 3 days. Pfizer is sending the vaccine in containers filled with dry ice to keep the formula at 94 degrees below 0 Fahrenheit. Meanwhile, President Trump says those working in the White House should get the coronavirus vaccine somewhat later in the program. That follows news that he and other top U.S. officials would be offered the vaccine within days. The president said on Twitter he asked that the adjustment to the timetable be made. He says he's not scheduled to take the vaccine, but looks forward to doing so at the appropriate time. And trade talks between the UK and the European Union have gotten another stimulus. British Prime Minister Boris Johnson and EC President Ursula von der Leyen gave negotiators still more time to close a deal. Officials involved in the process say an agreement could finally be reached this week. Global news 24 hours a day on air and at Bloomberg Quick Take. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
Karina, thank you so much. Now, coming up next, Joshua Sharfstein. He's Johns Hopkins Bloomberg School of Public Health Vice Dean. We'll talk about AstraZeneca. We'll talk about approval in the U.S. and rolling out of the vaccine. That's coming up next, and this is Bloomberg. This is Bloomberg Surveillance. Lisa and Francine from London and New York. Now, as we continue to track the virus, Bloomberg has developed a unique partnership with the leading authority on COVID-19. Johns Hopkins has been at the forefront of the international response, and every day we bring you insight from experts in public health, infectious disease, and emergency preparedness. Joining us now is Joshua Sharfstein, Johns Hopkins Bloomberg School of Public Health Vice Dean. Dr. Sharfstein, thank you for joining us. When you look at the rolling out of the vaccine in the U.S., how soon is that going to be?
Sounds like any day now they'll start vaccinating in hospitals in the United States, which is a great step forward. And then we'll get more and more vaccine. We'll see nursing home residents vaccinated. And then the real challenges start, because hospitals and nursing homes, it's pretty easy to find the people there. But once you get out into community settings, even if we're talking about very high-risk people, it's a much bigger challenge.
So, Dr. Sharfstein, based on what you're seeing currently with supply chains and with the rollout, when do you expect us to get to that all-elusive herd immunity where we can actually start living somewhat normal lives again?
It's a great question, and it really depends partly on the vaccine access and partly on what everyone else does, because, well, herd immunity is a concept where the virus really cannot, spread within a community because enough people are immune, and there's just no place for the virus to go. It's going to depend on getting the vaccine out there. We're going to need to invest in the vaccination systems that actually deliver vaccine to people who otherwise don't even get the flu vaccine. But then also it's going to be a lot faster if we can get on top of the pandemic in terms of more social distancing and mask wearing and just generally drive transmission down. If we can do both at the same time, we'll get to a point of very little community transmission much quicker.
Dr. Sharfstein, I want to talk about the here and now, the idea of the pandemic worsening in many spots around the country. And there's a question of how much the vaccine rollout will stave that off. Do you expect the vaccine rollout itself to be able to limit some of the spread? Or really, are we back to square one with just the same remedies that we were looking at earlier in the year of wearing masks and not necessarily hugging our friends?
Oh yeah, we should keep wearing masks. We should not be hugging our friends. We should stay distance. We shouldn't be, meeting up indoors without masks. That's very risky. The vaccine is fantastic. It will eventually lead the way out of the pandemic based on everything we know right now. But I think it's not going to do that right away. It's going to be at least a few months, and I think probably well into 2021, and it may vary depending on the country.
Once someone gets a vaccine, how long does it take for the body to build immunity to that?
Well, the Pfizer vaccine looks like the immunity really kicks in after about 2 weeks. And then with the second shot, it really stays for quite a while. So we'll see, but probably we start to see some impact a couple weeks after vaccination.
What is the one thing that you still want to know about the vaccine? And what is the one thing that would actually mean that more people get vaccinated? I know I ask you almost every week, but are there more people now that don't want to be vaccinated compared to what we thought a month ago?
I think it's really important. When this whole pandemic started, it was very scary. We didn't know much. And then we learned more. We learned how the virus was transmitted. We learned how to protect ourselves. It's a similar situation with the vaccine. We have a lot of information. We have great, large clinical trials, but we have limited follow-up. But we're not stuck in that position. We're going to get more information about this vaccine, about how quickly it works in real application in the world, about its full safety profile over time. And I think at each step, if things work out, we're going to get more and more confident, and we're going to see more and more vaccination.
Joshua Sharfstein, thank you so much. He's, of course, of Johns Hopkins, and be sure to check out VRUS Go on the Bloomberg for the latest information. You can also tune in every day for our exclusive conversation with Johns Hopkins experts for an inside look at battling COVID-19. Now, there is a lot of talk about London and whether they will be upgraded or downgraded to a Tier 3 system, which means that restaurants will close. In the UK capital, we understand that the Health Secretary, Mr. Hancock, will actually give out a statement. According to the Telegraph, he will actually then announce that London will go to Tier 3. So that's coming up later. And also coming up on the open, Robin Hayes, JetBlue Airways Chief Executive. That's at 2 p.m. in London, 9 a.m. in New York. And this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. we must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Okay guys, I'm placing a new order to sell short Canadian dollar again. The price I'm looking to sell at 127.508. $127.508. New order placed. Let's see.
Fight the coronavirus. That brings its total commitment to almost $1.8 billion. And there are multiple reports that baseball's team in Cleveland will drop Indians as its name. That comes after years of protests from Native American groups who feel the name is racist and insensitive. An announcement could come this week. Last summer, Washington pro football team dropped Redskins as its name. And that is the Bloomberg Business Flash. Back to you.
Karina, thank you so much. Now, Standard Life Aberdeen Chair Douglas Flint says the City of London is ready for a no-deal Brexit, but the rest of the country might not be. Well, he spoke with Bloomberg's Hasland Amin.
London and the financial services is ready. I think the rest of the country has quite a lot of adjustment to make. I think the chances of a deal get better with every hour that passes, in the sense that we come up against multiple deadlines, which have been final deadlines. And yet when they've got to them, both sides have agreed that it's worth continuing, because both sides can see that a no-deal end to Brexit would be very disadvantageous for both. And we do seem to be in agreement on almost everything, apart from, in fact, two areas. So hopefully over the next, whatever it is, 15 days or so, the two sides can reach an accommodation that means that we won't have the disruption, or we won't have the excess disruption we'd have with a no deal on the 1st of January.
As we've seen already, Brexit has yet to cause a major hit to financial services, but the jury's still out on the actual impact. A key question right now is whether or not the EU can develop as a financial sector. What's your take on that? I mean, how do you see the EU's capital markets coming together?
I think that's been an aspiration for some time, and it's been very difficult to achieve. I mean, there isn't a common legal framework, there isn't a common insolvency framework, there isn't a common tax framework, and it's very difficult to have a single financial market when you have divergences in those three areas. I mean, I think as far as the UK, as far as London's concerned, we compete with financial centres all over the world, and we will continue to compete on the basis of providing service that is better than anywhere else. And I think in many ways it's an impetus to strive harder and to make ourselves more relevant. So, I think people are prepared for the worst outcome, and we'll be competitive going forward.
That is the Standard Life Aberdeen Chairman Douglas Flint and our Hasland Amin. Now, sterling rising against all of its G10 currency peers this morning. The pound was sent higher after UK and EU leaders agreed to continue working on a trade agreement. But under the surface, there's still plenty of unease around the risk of a no-trade deal. Here with a look at exactly what we should be looking at is our markets reporter, Danny Berger. Hi, Danny.
Hi, Francine. Well, look, if you are a trader in cable, you have a very difficult proposition ahead of you. You really have since the past year, and that's that these deadlines tend to come, nothing happens. So if you're someone who wants to buy hedges around these deadlines, you tend to spend the money, and then it just becomes more or less worthless. And that's exactly what happened over the weekend. And if you look at what happened into the charts with the 1-week volatility measure on cable, you can see it spikes up on Friday. The Friday level is where that yellow line is, and it since has come down. In other words, if you were hedging against risk for this weekend, it didn't exactly pay off. And I've talked to traders about this who say they don't like to really go out and buy expensive hedges anymore when it comes to Brexit because that premium keeps being wasted. Now, part of the complication going forward, again, if you want to hedge, is that in terms of hedging around another deadline, it's not exactly clear when talks will end. We do have that December 31st deadline in that regard, but still, that's perhaps why looking at 1 month risk reversals shows more bearishness than the chart I showed you before. So again, when this line moves lower, it means more hedging against the pound, more bearishness. And it has popped up a bit, but still, if you want to go back in history and find a time that people were as bearish as they were now, there are only two other data points we can look at. One of them being the March sell-off during the pandemic, and then the other one is the referendum in 2016. So that just shows you, yes, the spot prices cash, that is moving higher in terms of sterling, but still underneath the surface, people want to hedge for the tail risk that there is no deal, that threat very alive and very present, Francine.
Danny, thanks so much. Our Danny Berger there with a look at what pound has been doing. Now, let's quickly go on to the data. The pound, as Danny was saying, jumping as much as 1.6%. It actually puts it on track for the biggest daily gain in almost 2 months. A couple of other things that we're watching out for is London possibly going back in a tier 3 system, or at least going back to the tier 3, which basically means that restaurants and bars are closed. We're expecting the Secretary for Health, Mr. Hancock, to give a statement at 3:30 p.m. London time, and the Telegraph saying that it could announce tier 3 then. Stocks definitely starting off the week in a bullish mood, though. Investors taking comfort from further stimulus bill negotiations in the U.S., also a possible impending deployment of the first vaccine in the United States. And then we heard from Michel Barnier, the chief negotiator on the EU side on Brexit, telling a private meeting of ambassadors that a trade deal with the UK could be completed as soon as this week. So another reason for the market to, if not cheer, at least be a bit calmer than it was last week. I'm looking at crude oil 47.12. Coming up, more Bloomberg surveillance, this time simulcast on radio and TV. This is Bloomberg.
It goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbonises.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
How do wages go up when there's so many people out of work?
The really important thing to keep in mind is we're starting a brand new economic cycle right now.
There is going to be a lot of investment. There is going to be a lot of spending and policy support.
Fiscal stimulus isn't there yet, and you've got a complete lack of coordination.
These central banks have locked themselves in to being stuck at their effective lower bounds.
It's not that we're not going to grow in 2021, is will it be enough?
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
From New York and London, for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on Bloomberg TV and radio. Alongside Lisa Abramowitz, I'm Jonathan Farrow. Tom Keene is away today. He'll be back tomorrow. Lisa Abramowitz, we're almost...
Okay, guys, I'm placing a stop on profit for Canadian dollar at 127.48. Let me use this one. 127.48. Also, I'm removing the order I placed at 127.508. So I removed that order and I placed stop on profit for 127.48. Okay?
Stay the same, or rather, the more things change, the more things stay the same.
Yeah, I think we've got to deal with the reality of what's about to take place this week. There will be discussions about this relief plan that you're going to talk about in just a moment, but also the data, Lisa. Later this week, retail sales, initial jobless claims. I think really important to try and understand the direction, the trajectory this economy's on. Just as vaccinations begin in America, we're here. The vaccinations start. How much pain in between before we can roll this out in a big way?
Yeah, and you've talked about this really importantly, the idea of the here and now being a lot of pain, a lot of people just looking past it. Today, U.S. lawmakers are expected to unveil that $908 billion bipartisan relief plan. What I find interesting is you're going to end up seeing two parts. It's broken into a $748 billion plan and a $160 billion plan, trying to strip out some of the controversial areas that we keep talking about of state and financial aid versus the liability issues around COVID. Also today, to your point, John, about the split fates of the here and now versus the future of a vaccinated America and a vaccinated world, New York City is halting indoor dining in restaurants yet again to stave off the spread of the virus. Also today, the U.S. Electoral College meets to officially elect Joe Biden as next president. John, we're still talking about this. President Trump has lost several court cases. A lot of people are expecting this to sort of put a cap on this election season.
Still got to work out the composition of Congress, of course, the January 5th runoffs in Georgia, the next stop. What a first week of January we've got for you. When we kick things off, we've got the runoffs in Georgia, then we've got payrolls Friday shortly after that. I know we've got to get through 2020, but the first week of January, we hit the ground running and running hard. Here's the price action this Monday morning. Good morning to you all worldwide. Here's the equity market. On the S&P 500, 3681. Up 0.8%, up around about 28 points. This time last year, Lisa Abramowitz, what do you think the year ahead, year-end 2020 consensus was for the S&P 500 in the survey we do here at Bloomberg? What do you think the average S&P year-end forecast was?
3,400.
3280.
Wow.
3280 was the average call on Wall Street for where this market would finish. And we had a nice little sneak peek of 3,700 in the last week. Now, Lisa, if we told these analysts, these strategists on the sales side what would happen, this time last year, looking out 12 months, I'm not sure they would have upgraded their forecast to 36, 37, 3,800 on the S&P.
No. If you talk about a global pandemic, the worst, steepest recession since the Great Depression, people wouldn't naturally say, wow, it must have been quite a rally on the S&P. I do want to say, though, that one thing that caught my eye over the weekend was Morgan Stanley predicting that central banks globally would put $2.8 trillion of additional bond purchases, additional liquidity into global markets over the next year, just to give you a sense of how much more we have and what's actually supporting this rally.
Mike Wilson and the team at Morgan Stanley, they're at 3,900 for anyone interested. 3,900 on the S&P year-end 2021. Peter Scher joins us now, Academy Securities Head of Macro Strategy. Peter, what a couple of weeks this has been. Are you leaning into this? Leaning into some of the euphoria that we can all feel?
Yeah, I'm a little bit cautious. I think we have to make it through Tesla's inclusion. I think a lot of this Band-Aid stimulus has already been priced in. So I'm leaning into a little bit, and I still really expect a big rotation where the have-not stocks do well. Because next year I expect stimulus, but I expect, proper stimulus, where we really focus on job creation, where we're going to get a big bang for the buck, maybe involve an infrastructure bank, get public-private. So I view this current stimulus, it's nice, but it's nowhere near sufficient for what we need to get real economic growth.
Well, let's get the policy call right first, and then we can get to the market call. The policy call this year has just been the only call to get right, and then you've absolutely nailed the rest of it. Lean into risk. The policy call, you called this an aid Band-Aid. Peter, it's $908 billion what's on offer today. Is that a Band-Aid these days?
Unfortunately, it is. As we're shutting down more and more businesses, I think we have to make sure those people receive some sort of compensation. So this is more just to keep things going, as I see it. And we're not seeing true economic spending where we're going to get real growth. We're not seeing enough spending towards rebuilding manufacturing, fixing some of our infrastructure, making sure we catch up and surpass other countries on 5G technology. So that's what I expect to happen next year. And that's where we'll get the real boost. This, for now, I think, is really just covering up the problems that are coming from this resurgence in COVID cases.
Covering up the problems, is that enough to justify the rally that we've seen on the heels of expected support financially from Washington, D.C., and potentially the end of the pandemic at some point next year?
Yeah, I think we're reasonably priced. I think the market's kind of figured out the pandemic. We have to make it through this struggle right now. But ultimately, with vaccines and treatments and everything improving, we will get through. And some point next year, the economy should look very good. And that's why, again, even today, you're starting to see some of the small caps, value stocks continue to outperform big tech as this belief sinks in that, hey, we will have something that resembles a normal economy. It won't be work from home necessarily. It won't be going back to the office. But there's a lot going on. There's a lot of reason for optimism. There'll be ongoing central bank support. I think the Treasury Department will work well with the Fed. So I don't think we're mispriced. I just think we're due for a little pullback, especially surrounding this Tesla inclusion in the S&P 500, which occurs at the close Friday.
Okay, so we'll get to Tesla perhaps, but I'm wondering about Airbnb and DoorDash and some of these other IPOs that are coming out with valuations that are reminiscent of the tech bubble. I mean, the idea that they doubled in price, does it give you a feeling of froth, or is this also reasonably valued?
I think that's typical for these sorts of very hot IPOs where you don't necessarily want to squeeze every last cent out. You're only releasing a small number of shares. So it sounds like the company maybe left money on the table, but the bulk of their shares are still kind of held in reserve that they can issue going forward. So I'm not worried about that. I think there's been a lot of, hyperactive trading. We do see a lot of these small accounts participating. Whether these prices all last or not, it's a little bit, up in the air. Again, I think this is really going to depend on what we get in terms of policy next year. And partly what we haven't talked about is the negative potential for policy. Do we see tax increases again, especially at the corporate level? And then some of these valuations might look a little bit more frothy.
Peter, do you think that comes on the table, that conversation, at some point in 21?
We've been looking at this market as we think Congress and the Senate and the president are going to try and address the, everyone's been talking about this K-shaped recovery, that downward slope of the K. I think that gets addressed, right? And that's all good. That's the positive. That's the stimulus. The question is that upward slope of the K. Do they do something to punish that? Do they say, hey, you've been really successful, so we want to take something away from you? Or do they let that slide? I think for the economy, it's probably indifferent. For markets, it's much better if they let it slide. I think a lot will hinge on that Georgia election.
January 5th, Peter, for you, is that when you start to establish what your year outlook really looks like after that event?
Yeah, I think right now we've got a base case of we're going to get some decent amount of stimulus because I think the Republicans are on board. They kind of failed to get any sort of stimulus done, which, you know, of all the things I would have expected President Trump to be good at, it was building things. We did not get any infrastructure done. So I think some level that's going to be done regardless of the outcome. I think the outcome is going to switch how much. So if the Democrats win, we'll see more spending. I also expect it to switch the mix. So we'll see a much bigger environmental and sustainability focus if the Democrats win the Senate. I think less so if the Republicans retain the Senate.
So given all this fiscal support that you're expecting and fiscal stimulus, actual stimulus next year, Treasury yields, are we going to see them above 1%? How high can they possibly get?
No, I think we get them above 1% fairly quickly. I'm kind of in the near term, call it the next few weeks, thinking we're between 1 and 1.25. I think it's hard to get much above even 150. I think the Federal Reserve will work very closely with the Treasury Department to control any rise. And again, markets, I think, will be fine if we see a rising Treasury yield, so just as long as it's not a rapidly rising Treasury yield. Though again, to me, that would really help these small economies, those cyclicals, and probably less helpful for some of the big, large tech valves.
Yellen and Powell working hand in hand. Peter Cheer, great to catch up, sir. Peter Cheer of Academy Securities. Peter, thanks for everything this year as well. Have a fantastic Christmas if we don't talk again. Peter Cheer there of Academy Securities on this market. Lisa Abramowitz, Wednesday, the Fed. You asked the question about yields going through 1%. Do they give it the green light?
Yeah.
Or do they suggest they'll be ready to step back in?
Well, a survey of economists has talked about how they expect them to tie their increase in longer dated bond purchases to financial conditions more intimately, but not start to extend the duration of their purchases. But everyone is expecting them to increase the length of the bond maturities. Again, you have to wonder, John, what they're hoping to achieve at a point when you don't necessarily see financial conditions exactly tight.
So I think there's a big difference between hoping to achieve something and hoping to prevent something.
Good call.
And I think at this point for the ECB and the Federal Reserve, they're hoping to prevent worse things from happening. And I think they recognize that the additional dollar or euro of QE isn't going to achieve much at all. It's the fight with the counterfactual, Lisa. What happens if they step away? And I think we both know what happens if they step away at this point, given where these markets are trading.
Well, and that's the question. If they don't signal some sort of change to their bond purchase program, what does that do? I mean, do you get a taper tantrum, what Priya Misra was talking about, or do people shrug it off? That's, to me, the big unknown.
We do not want that into year end. Brian Weinstein might. Morgan Stanley head of global fixed income. I'm pretty sure Brian Weinstein's not calling for it.
Yeah, I was about
He'll be joining
to say.
us a little bit later this hour on Bloomberg. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keane out of the building. He's taken a nice little day off, a long weekend. He'll be back tomorrow. Futures are positive, up 28 on the S&P 500. We advanced 0.75% to kick off the final full trading week of 2020. For our audience worldwide on radio and TV, this is Bloomberg.
With the First Word News, I'm Karina Mitchell. Hospitals in the U.S. will start getting the coronavirus vaccine today. Shipments started leaving Pfizer's Michigan factory yesterday. Over the next 3 days, the shots will arrive at more than 600 hospitals. The 2.9 million doses will be given to healthcare workers and nursing home residents. Meanwhile, Russian government hackers reportedly have hit several U.S. agencies. According to the Washington Post, the attack targeted systems within Treasury and Commerce and other government agencies. The newspaper says the agencies were breached through the server of a network management system called SolarWinds. Members of the Electoral College meet today to officially elect Joe Biden. Some Republican lawmakers have said that would be the end of President Trump's attempts to overturn the results as far as they're concerned. Electors are committed to voting for the winner of the popular vote in each state. The president has said he will continue with legal challenges. Deutsche Bank may eventually allow some of its 4,600 employees in New York City to move elsewhere. The German lender is preparing to move operations to the Time Warner Center in Manhattan. It's discussing how to allow more employees to work from home and from other locations. And he was the master of the spy thriller and defined the moral ambiguities of the Cold War between the Soviet Union and the West. British author John le Carré has died. He was once posted to Berlin in the 60s as an intelligence agent, and that city became the setting for his bestseller, The Spy Who Came In From the Cold. Le Carré followed that with novels such as Tinker Tailor Soldier Spy and Smiley's People. John le Carré was 89. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Yesterday, we get on the call again this afternoon to finish things up. We'll have a bill produced for the American people tomorrow, $908 billion.
Just like that, Senator Joe Manchin, Democrat from West Virginia, speaking on Fox News over the weekend. He knows it's harder than that. For our audience worldwide, good morning to you all. Alongside Lisa Abramowitz, I'm Jonathan Ferro. This Monday morning, this market kicks things off with a little bit of a rally, a pickup on the S&P 500, up 28. We advanced 0.75%. In the FX market, dollar a little weaker, euro dollar 121.56, just off the highs for 2020, up about 1/3 of 1%. And in the bond market, Lisa touched on this a little bit earlier this morning. Yields up just a little bit here, up a couple of basis points on a 10-year to 0.9212%. Ahead of retail sales and the Fed this coming Wednesday and initial jobless claims once again this coming Thursday. Lisa, this was the line from Senator Manchin. No way that we're going to leave Washington without taking care of the emergency needs of our people. And let's be clear here, Lisa, that was part of the conversation over the past week. Could they get something done before year end?
It still is. I mean, it's not a done deal. They've been talking about the necessity to get some sort of deal done for months now, John. We've been talking about it. Can they bridge the gaps that have been perpetual throughout the past several months? I don't know. I mean, I'm still not seeing it necessarily, John.
Well, let's talk about the number of the morning, 9:08. Kevin Cerruti joins us now, Bloomberg Chief Washington Correspondent. Kevin, the number of the morning is 908, 908 billion, but maybe it's still the 160. Two parts. Just walk me through the mechanics of this. What's being proposed? What's being unveiled a little bit later?
Well, that's exactly where I want to take the conversation. And talking with sources over the weekend, they're actually viewing this as Senate Majority Leader Mitch McConnell's 1-2 step, so to speak, of getting stimulus without state and local aid. There are two chances, essentially, for Republicans to get on board with fiscal stimulus that does not include what they view as wasteful spending for additional allocations to state and local governments. And that's at about a $670 billion proposal to $700 billion, coupled with the 160 package that is just a standalone for state and local aid. Now, Democrats are going to have a choice. It would likely, based upon my reporting, you could see a scenario where centrist Democrats and the Democratic Party get on board with the first proposal, which does not include the state and local funding, and then you see a breakaway of Republican support for the 160 proposal. So it's a calculation, essentially, where they are saying that they could push forward some fiscal stimulus and have an opportunity, albeit a narrow one, to get a path of fiscal stimulus before they all leave town.
Kevin, it makes sense. Leader McConnell has proposed this idea almost repeatedly over the last several months in one way, shape or form. Kevin, my question would be, where is Speaker Pelosi on this? Because I'm sure she's aware that if you propose this idea, if you put it to the floor, put it to the vote, if it goes through the 748, if that gets approved, state aid's not getting done. And it's not getting done before Christmas. It's most likely not getting done after Christmas, dependent, of course, on what happens on January 5th.
If that happens, and again, I try to stay away from hypotheticals, but if that happens, this would be a strategic win for Leader McConnell to have outmaneuvered Speaker Pelosi and the Democrats. As you just mentioned, this was the offer that he had put forward for months. Do a standalone bill without funding for state and local officials, or for state and local governments. And instead, they're doing exactly what he wanted with two different bills. If it all goes up in smoke, this is a stare down that Speaker Pelosi won. And we'll find out in the next 24 to 48 hours.
Where's President Trump in all this?
Not negotiating. In a sense, Speaker Pelosi and Secretary Mnuchin are scheduled to talk sometime today, but President Trump has really been focusing on the Georgia elections. He has not been, as we've seen him in years past, working the phones, trying to coerce Republicans in his party to get on board with a fiscal stimulus. Instead, Secretary Mnuchin has really been the one driving this. But it's, again, a stare down between Leader McConnell and Speaker Pelosi.
The people who you talk to, do you get the sense that either side, the Democrats, the Republicans, are willing to cave on those two key issues, state and local government or liability with respect to COVID and the spread?
To be candid with you, I think centrist Democrats are much more willing to pass a package of fiscal relief that does not include state and local aid than Republicans are to give up liability protections. And I say that simply because many of those centrist Democrats are representing suburbs and not necessarily the cities in which that are in dire need of that additional support and from their perspective. So that's really where the balance stands.
Kevin, let's just wrap things up by sitting on the milestone of the moment, the milestone of this year. Vaccinations could begin in the United States of America today. What are you looking for, Kevin?
First and foremost, whether or not the bipartisan group of lawmakers, of which there are many, are able to get on board and follow the profile encouraged leadership that we saw from three former presidents, all saying jointly that they would receive the vaccine. If they follow that message and educate the public about this incredible scientific breakthrough, and they provide funding for the National Ad Council to build that public trust, That is first and foremost. We could see that next week in the omnibus bill. And then secondly, just beyond that, about another major milestone today of the Electoral College casting their ballots across the country, 538 members. And what does that show when President-elect Joe Biden officially crosses that threshold? How will Republicans work with that administration, incoming administration, to make sure that 80%, as I read on the Bloomberg terminal on my way into the Bureau this morning, 80% of the public has the opportunity to be vaccinated by the summer?
Wow, maybe by June. Kevin, before we let you go, just quickly, do you use Gmail? Are you a Gmail user?
I'm a Bloomberg terminal user first and foremost.
Oh, okay. Well, you might not be a Gmail user today, even if you were. Lisa Brown, some headlines crossing the Bloomberg. And Kevin, thank you, by the way. Very diplomatic.
I mean, really, I'm a Gmail
Lisa,
user, I've got to say. I will concede to that. Yeah, basically, this just crossing the Google services. There's an outage that's hitting Gmail, that's hitting YouTube, that's hitting Pokemon Go. If you play, evidently, you are not getting access to Pokemon Go. I know that, John, that will crimp your style dramatically. But basically, the website Down Detector detected thousands of complaints as of 7 a.m. in New York, tens of thousands of complaints, people unable to access their Gmail. I wonder, this actually affects workload too, because people actually stream some of their work emails into Gmail in this work from home environment, John.
Oh, the excuse not to work from home today is readily available for people and users of Gmail, provided by Lisa Abramovich. Just quickly, Lisa, Pokemon Go.
Yeah.
Is that the game that the kids used to go through Central Park looking for monsters?
Yeah,
Is that Pokemon Go?
Yeah,
Was that
I think
a few years ago. I didn't realize it was still around.
It is, and I actually think that Vet Bill really enjoys Pokemon Go, and that might be what Tom Keene was hoping for today.
Maybe that's why Tom was off anyway. He was struggling this morning. Bit of withdrawal, feels a bit upset. Did you see the case of wine that Tom Keene opened going into the weekend? Let me tell you, that's why Tom had the Monday off. A massive case of red wine shipped over. I'm sure he had a great one. Alongside Lisa Abramovich this morning, I'm Jonathan Ferro, counting you down to the opening bell. A couple of hours away. Equity futures doing nicely, up 0.8%.
our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
From New York and London for our audience worldwide, good morning to you all. This is Bloomberg Surveillance, live on Bloomberg TV and radio. Let's get to the price action this Monday morning. We advance on the S&P, up 0.8%, up 29 points. Advancing on the Russell as well. The small cap's up a little more than 1% after a sixth straight week of gains on the Russell 2000 in America. That's the equity market on the session, 12 months out. JP Morgan looking for 4,400. That's the top end, the high forecast on the street at the moment. 12 months out, year-end 2021. At the low end, Savita Subramaniam, good friend of this program, at Bank of America, looking for 3,800. That spread is actually wide, wide, wide. Speaking of the spread, get to the bond market. We look at 2s and 10s. Your outlook for that might hinge, probably does hinge, on what happens this Wednesday at the Federal Reserve and whether we get any clarity whatsoever on the bond buying program at the Fed. Most people believe that they are the reason that yields aren't pushing much, much higher here. Not just the data, not the outlook, but the Federal Reserve as to whether they will extend the average maturity of their asset purchase program. This morning, yields up by a couple of basis points, the curve steeper by 2 or 3 basis points so far. 0.92% is where 10s trade, 166 is where 30s trade. I'll finish on this in foreign exchange, just one currency pair, cable. Off the back of the worst weekly performance on the pound against the US dollar since September, we bounced back by 1.5%, £1, a nice 134.28. And Lisa, the story here, they're going to keep talking. That's bullish sterling, apparently. It is that simple, and that's all I've got to say on the matter.
You really don't want to talk about it further? Deadlines? Anything philosophical?
Maybe with Maria Tadeo from Brussels for a couple of minutes, but I've got nothing to add personally, no.
All right, Maria Tadeo, come and inform us a little bit more of Bloomberg joining us from Brussels. So they agreed to more talks. How close are we to actually avoiding a hard Brexit?
Look, it's very hard to answer that question at this stage, and I really hate to not be able to answer the question, but you see that in the market, all it takes is the fact that they're still at the table to give sterling a push. And here's the thing, you know, Sunday had been framed as a make or break moment. This was a deadline. If the Prime Minister was serious about walking away, he could have done that yesterday. Instead, he says he wants to make a deal if a deal is possible. I do want to say, however, this morning, Mr. Barnier, who leads the negotiation when it comes to the EU side, he did tell EU ambassadors that he does see a path to a deal. He also said that the EU potentially could move on the level playing field. Remember, this is the future competition, and the Europeans, to their credit, have changed their tone. They're saying they're not expecting the UK to copy and paste the regulation. If they move away, what they'll do is to restrict the access into the single market, but they're not going to ask Boris Johnson to replicate every single thing. If they move on that and the UK moves some fish, potentially that could open a path to a deal.
Deadlines. Just briefly, Maria, is December 31st a deadline, a hard deadline? Can that be moved?
Look, it's a hard deadline, and in principle, it could not be moved. John, this is the legality and the technicalities going into that. It could not be done. And also, I would say politically, there's no appetite to extend that in any way, and they want to wrap this, if it can be done, with a deal before that. But that date really matters. This is not a bluff. That date is set in stone. By December 31st, the UK will leave and will trade on WTO terms with the EU if there's no deal.
So how do they ratify a deal in respective parliaments, Maria, with the time that we have left, if they don't extend that December 31st line in the sand?
Exactly. Look, so that is set in stone for leaders to agree to a deal. So that means Boris Johnson and the EU 27 countries. Now, in the interim, while we wait for the EU Parliament and the UK Parliament, they could find a way to extend what we currently have, but it doesn't mean that you could go on and on and on without a trade deal. Essentially, this would be seen as an emergency measure just to bridge the time in which you get the deal at a political level from the European leaders and the Prime Minister and put it to a vote in the EU Parliament. But that is not something that we could have for weeks or being extended ad infinitum forever. It's very much seen as just a transition to bridge that gap between the deal and the vote to ratify that deal.
You'll have to forgive me, Maria. You're far more informed than me on this matter. I've just been conditioned by the experience of the last 4.5 years that you should probably never assume anything when it comes to these talks between these two sides. Maria, fantastic to catch up with you, as always. Maria Tadeo there over in Brussels. Lisa, we're told that it's a hard deadline. December 31st cannot be moved. I was told a week ago they had no appetite to extend talks beyond Sunday, and here we are Monday morning, still talking.
How do you feel, really? I feel like this is really subtle, John. I'm not clear exactly on what you think about this deadline.
I think I've been subtle, haven't I, over the last week on the matter?
Subtle. New definition of subtlety. I think that there is a question a lot of people
I've
have.
buried how I really feel. This is just a flavour. This is just a little flavour of it. Enough Brexit. Brian Weinstein joins us now, Morgan Stanley head of global fixed income. Brian, let's talk about the other event of the week. I'm not even sure that Brexit is the top of the list for many people. This Wednesday is the Federal Reserve decision. What are you looking for from the Fed this Wednesday?
Yeah, good morning, Jonathan, and good move on Brexit. Rather not talk about that. So listen, the Fed will be interesting. I mean, we think it's a real close call, 50-50, which is not, I know it sounds like a cop-out, but at the end of the day, we think they probably won't go for moving the extension of the buying. Better to save it for later if rates rise. Better to save it for dry powder. If you look at the world, we'll probably get some stimulus. The equity market's doing great. Break-evens are creeping higher. I think they'll give us some language. I think they're going to try to link more closely to the average inflation target, remind us they're not going to raise rates. There's a couple things that they could do to tell us maybe when they'll look at this extension of the buying, the average maturity of the buying. But it's a close call. They could do it. I don't think it's a huge deal if they don't, so long as they give us some language, and rates probably keep creeping higher.
Well, Brian, you mentioned break-evens, inflation expectations creeping higher. Do you think that could be the green light for nominal yields to start to pick up through 1%, maybe towards your target through 21?
Yeah. I think that they could move higher. I mean, the 321 seems a while away, but getting 10-year notes into the 1% range, I think, is a very likely outcome. If you look at across the world, Australia and New Zealand, for example, we've seen rates start to creep higher there. Even though the central banks have stayed dovish, it just at some point isn't enough anymore, and the markets get restless when you see growth, when you see break-evens. I think stimulus would be the last piece of that in the U.S. Remember, we need stimulus, right? The output gap is still big. We still need growth in 2021 and 22 to offset the lack of growth this year. So stimulus would be a big piece of getting rates higher, along with the Fed not being aggressive on extending their purchases.
So let's talk about the consequences of additional quantitative easing purchases, additional purchases by the Federal Reserve of treasuries and other central banks around the world. I know Morgan Stanley has a forecast of about $2.8 trillion of bond purchases or asset purchases by the major central banks next year. How much of that has already been priced into riskier debt versus yet to be really factored in?
It's a great question, and one that we struggle with a lot. There's no question that a lot of it's been priced in, right? I mean, how is stimulus not priced in? How is the vaccine not priced in? But the market still enjoys when these events happen. And listen, I think it's done well, and we do get the growth. There's a reason to believe that this can continue. So it's hard to look at risk assets and say that none of this is known. The question, I think, is which risk assets does this help the most? And so when you look at treasuries and you look at investment-grade credit, where the most help was given, that's probably where the least upside is. When you look at the high-yield markets, the loan markets, the equity markets, some of the emerging markets, anything that benefits from a weaker dollar, there are many, many things that you could still have great outcomes in. You just have to have some of these actually come to fruition.
So a lot of investment managers come on the show and they say, well, it's time to pick particular bonds and not necessarily indexes. And other people will say they're talking their book because they're active managers. Is this going to be a specific bond, a specific company story where you end up with certain defaults and others that do just fine? Or is this still an index story, still a big macro beta play on just more QE and more risk on?
No, listen, as an active manager, we do like picking bonds, and certainly this has been a good year for indices. Although, listen, it's been a great year for some stock pickers, right? Some of those certain tech stocks and things like that have done tremendously well away from the indices. But yes, I think if you stay in this world where, as I said, treasuries and investment-grade credit have done the heavy lifting, and you're going to go into these markets now, it's harder to buy an EM index. It's not as smart to buy a high-yield index. There are lots of active things that you should be doing in sectors that you should be avoiding. The beta play is probably towards the tail, and now some of the bigger winners here will be more actively selected based on the outcomes of where the stimulus goes, which EM countries are stronger, which EM corporates have better balance sheets. Those things should matter more now that the beta rally is at least mostly played out.
Brian, let's just wrap things up there. I think it's really important too. That word avoid that you just used. A lot of people come on shows like this at the moment talking about embracing cyclicality. Any cyclicality, any cyclical areas of this market, Brian, that you would avoid?
In fixed income, it's a lot harder because the cyclical nature, it's just a bit less cyclical. Listen, I think when I say avoid some of the things in beta, when we look at the high yield markets, we think there's still be plenty of defaults, right? We still have energy problems working through the system. In EM, there are still plenty of countries where that matters and where stimulus is not getting to those countries, and they can't do it because of their balance sheets. So I think, no, I don't think there's anything in fixed income as a sector that you need to avoid. I do think it's much more micro, which makes it a little bit harder to go into in detail.
Brian, brilliant to hear from you, as always. Brian Weinstein there at Morgan Stanley. Thank you, sir. Equity futures this morning up 30 on the S&P. We advanced by 0.8%. Lisa was talking about the Google outage around about 10 minutes ago. A Bloomberg subscriber writes in, Lisa, and says the following: just received this from the kids' school.
Oh, yeah.
Google systems are out in the area. No virtual learning today. So this is a snow day for some people.
Not
in
the parents.
2020.
Not the parents, I'll tell you
not
that.
Not the kids.
Because I'll tell you, remote
the kids,
schooling.
Yes, not the parents.
Remote schooling is tough when you have a working parent. It's that much harder if you're dealing with no school and you're basically trying to occupy your children. If you are in that situation, I feel for you. I've been there. John, it's tough.
Lisa's talking from experience. Tom's at home with two of them, so Tom's having a good day off.
Yeah, exactly.
Love that. Love that.
You know,
going to reach out to Tom very shortly and find out.
Yeah, well, I mean, it does raise a question, right? What do you do if you do rely on some of these systems? And Google will have some serious questions to answer. Interesting to me that the shares are not down more in pre-market trading. They kind of blipped down, but now are basically flat on the day. Kind of interesting that people seem to be shrugging it off.
This market's flying. We're up 0.8% on the S&P 500. Really interesting week ahead. Economic data, retail sales Wednesday, jobless claims on Thursday. The Federal Reserve in between. For our audience worldwide, heard on Bloomberg Radio, seen on Bloomberg TV. Alongside Lisa Abramowitz, I'm Jonathan Ferro. Tom Keene out of the building. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Healthcare workers and nursing home residents will be first in line when U.S. hospitals begin giving coronavirus vaccine shots. The first 2.9 million doses arrive at more than 600 hospitals over the next 3 days. Pfizer is sending the vaccine in containers filled with dry ice to keep the formula at 94 degrees below 0 Fahrenheit. Meanwhile, a group of Republican and Democratic lawmakers will unveil a $908 billion coronavirus relief plan today. There's still doubt that Congress will pass it, however, so they'll offer language for two separate bills. One will have provisions that have divided lawmakers, will call for state and local aid and liability provisions for businesses. And trade talks between the UK and European Union have gotten another stimulus. British Prime Minister Boris Johnson and EC President Ursula von der Leyen once again gave negotiators more time to close a deal. Officials involved in the process say an agreement may finally be reached this week. And Google services, including Gmail and YouTube, are experiencing widespread outages around the world. The products are failing to load for users in New York, the UK, and across Europe. Still, Google's search product was functioning normally. YouTube said on Twitter that it's looking into the problem. And there are multiple reports that baseball's team in Cleveland will drop Indians as its name. That comes after years of protests from Native American groups who feel the name is racist and insensitive. An announcement could come this week. Last summer, Washington pro football team dropped Redskins as its name. Global news 24 hours a day on air and on Bloomberg Quick Take. powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is a monumental week for us all as we distribute the first millions of doses of vaccines to the American people. We'll be working it hard the next couple of days to ensure these first shipments go very well. It is the foundation for all future deliveries.
A monumental week for us all. In the United States of America, the vaccinations begin. Army General Gus Perna there, Operation Warp Speed, Chief Operating Officer from New York and London this morning. Good morning. Alongside Lisa Bravitz, I'm Jonathan Ferro. Here's the price action of the moment this morning, a monumental moment for the country. In this market, it's been that way for months. Equity futures up 30 points on the S&P 500. We advanced 0.8%. In the bond market, Lisa, up about 2 or 3 basis points going into the Fed, 0.9246%. But Lisa, just so range-bound over the last several weeks. We've had weeks where we're up a lot and weeks where yields are down a lot.
Yeah, and not necessarily breaking out. Interesting, not confirming necessarily that rotation into growth that we're seeing in other areas, John.
Will this vaccine unlock higher Treasury yields? Will this vaccine get us back to what you might consider normal by the middle of next year? The vaccinations begin this week. It is a massive moment in the United States. And joining us now is Dr. Joseph Cachone, Ascension Chief Medical Officer. Doctor, fantastic to get you with us on the program. Let's just start first up. Have you got the vaccine in-house? And talk me through how big this week is.
Yeah, this is a big week. 9 months of what we've been dealing with and what the public has been dealing with. We're very excited. The vaccines are arriving today on many of our hospitals. We have 150 hospitals across 20 states, and we anticipate vaccine deliveries today. And we've been preparing for that for the last 8 weeks. We've had teams working every day on the logistics and delivery of the vaccine. So we're really excited about this. We feel this is the way to get us on the other side of the pandemic.
We'll hope that's the case, Doctor. When you look at the rollout, it's pretty clear to everyone, frontline workers, the most at risk in society first. Are the decisions on who to give it to in-house first, Doctor, in the initial rollout, the first few weeks, is that difficult? How do you come around making those kind of calls?
You know, we really have strongly encouraged our employees to get the vaccine, and our employees are stepping up just like they have through the entire pandemic and are volunteering. We obviously can't vaccinate everybody in a single unit in the same day, so frankly, we're just asking people to schedule their vaccine with us, and we are managing that scheduling process just like we would any other appointment. Our frontline workers are really the hospital workers, both nurses, our respiratory therapists, patient care techs. Those are the people that we're prioritizing, and critical care nurses in particular, which really have bear a huge part of the brunt of this, as well as the respiratory therapists and patient care techs. We really want to get them vaccinated early. And so we're prioritizing that group. Our frontline physicians are also very important. Our critical care specialists, our infectious disease specialists, our pulmonologists. We're very excited for our employees and really strongly encouraging them to get the vaccine.
Dr. Cachone, it's interesting how the initial rollout will be viewed as a template for the further and more extensive rollout that is expected perhaps in the first half of next year. How complicated is it logistically, given the cold temperatures that you have to keep the vaccine, in addition to some of the other just typical vaccine logistical issues?
You know, it is a challenge. You know, we have to store between -60 and -80 degrees. We have to be prepared to receive the vaccines cold from Pfizer. I will say that Pfizer, I've been on logistics calls with the Pfizer folks. They've done an incredible job orchestrating this. And so I'm very impressed at the way Pfizer has approached this. It has posed a problem. We've had to go out and get a bunch of freezers. Some of those where we can't get freezers, Pfizer's made it so that the shipping boxes that they come in can be recharged with dry ice, and we can store them in the shipping containers. So I think they have done an incredible job doing that and providing us backup plans in case freezers were unavailable. As you can imagine, it was hard to, the number of freezers that we need for a health system our size. We're getting there, but we're not quite there yet.
Which raises a question about who pays for all of the extra equipment that's required in order to roll this out in an effective way. I know there has been some money appropriated that has not yet been passed in Washington, D.C. Beyond your particular organization, Ascension Hospitals and Healthcare Facilities, is this going to be expensive? Who is going to pay for it at the end of the day?
You know, as part of our health system, you know, our CEO told us at the beginning, take care of our associates, take care of our patients, and worry less about the economics. And in a global pandemic like this, with the number of people that have been affected by this and the number of lives lost. We have put our patients and our associates first. And as for that reason, we haven't thought about that as much. It is something that weighs on our mind over the long haul, but for the short term, we're really focused on delivering this vaccine. And for us, we're paying for it. You know, the government has provided us CARES Act funding, but we are paying for it out of Ascension. And this is part of normal business for us. There are technologies that come up all the time that we have to pay for before somebody actually reimburses us. So this is just part of normal business for us. And, you know, our commitment to this is overwhelming, to say the least.
Doctor, just before we let you run, I think a massive issue over the last 9 months, as you know, has been compliance around social distancing, mask wearing, etc. It's not just about the first vaccination. You've got to get them to come back. They've got to come back for the second hit. It's going to be hard enough to get people to step up for the first one. Can you walk me through the kind of techniques, the marketing around this that you think is effective, that you'd like to see in the coming months?
Yeah, it's really about education, you know, and we have significant issues in some of our populations that have trust issues. You know, we have the Black African-American population, the Hispanic population that have trust issues with the medical community. We have to continue to educate. We have to be culturally sensitive. We have to use our leaders, our Hispanic leaders and our Black African-American leaders to actually help educate those populations, to give them the trust to get this vaccine, because it's a very important. You know, the more vulnerable you are to illness, the sicker you are, the more likely this vaccine is to help you. And so we have to get that message out. It's going to be about education. And I just want to emphasize one other thing. You know, as part of this whole thing, we've been absorbed with COVID, but there is a secondary pandemic that's out there right now, and that is people are avoiding care, avoiding coming to our hospitals. We're strongly encouraging people not only to seek the vaccine, but also to continue to seek care for other medical issues.
Doctor, we would love to continue the conversation with you through the next couple of weeks and the next several months as this rollout really picks up. Dr. Kachun there, thank you very much, sir. Lisa, it's not the end, it's the beginning of the end, and it starts this week in America.
Yeah, hopefully a lot of people will get on board taking the vaccine, given the fact that this really is the way to end it.
Coming up on this program, Lisa Hornby of Schroders for our audience worldwide this morning. Good morning. This is Bloomberg.
Retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Wages go up when there's so many people out of work.
The really important thing to keep in mind is we're starting a brand new economic cycle right now.
There is going to be a lot of investment. There is going to be a lot of spending and policy support.
Fiscal stimulus isn't there yet, and you've got a complete lack of coordination.
These central banks have locked themselves in to being stuck at their effective lower bounds.
It's not that we're not going to grow in 2021, is will it be enough?
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
From New York and London for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Lisa Abramowitz. I'm Jonathan Ferro. Tom Keene out of the building. He'll be back with us tomorrow. Lisa, we have a vaccine approved in the United States. The question now, there are several. The vaccinations begin. How many people can we vaccinate and how quickly?
And how much of this is already priced in? I mean, if you take a look at markets, they seem to be cheering this. They seem to be cheering everything. Is it don't fight the Fed, don't fight fiscal support, or don't fight the herd mentality? Gains beget gains until they don't.
And right now, that's true in the S&P 500. We add some weight to the S&P, up about 31 points on the S&P. We advance 0.8% on the S&P 500 this Monday morning. Into the bond market we go. Yields higher. This curve is steeper. We're up 3 basis points on a 10-year to 0.93. On 30-year yields out to 167. But Lisa, before you bury your head in the sand of Q2, Q3, Q4 2021, got to finish out Q4, got to get through Q1. Germany's going into hard lockdown over Christmas. London, all reports suggesting, is going into the strictest tier here in the United Kingdom of restrictions. It's going to be a tough time for this economy, not just in Europe, but we saw it in the United States over the last couple of weeks. The wrong kind of upside surprise on jobless claims. Retail sales Wednesday, payroll's coming up in several weeks' time, and some people believe that payroll's print for this month could be negative.
Yeah, but will it matter? I mean, honestly, at what point does the actual data and the actual facts on the ground matter when people are simply ignoring it all, looking past it and looking to valuations? And the fact that a lot of the companies that have driven the gains seem to be benefiting from the stay-at-home economy regardless. John, it's sort of hard to square the reality with the future that seems to be what everyone is simply looking to.
On the stay-at-home economy, just some news from Google. Lisa talked about this about 30, 40 minutes ago on this program, having some problems with various parts of the company, outages with Gmail, etc. Problems with the vast majority of users should now be resolved. So Lisa Abramowitz, back to school is on, virtually speaking, for some of the kids that were maybe getting happy about the prospect of not having school today, virtually speaking.
Why do you empathize with the kids? I mean, honestly, the parents are so relieved right now, John, and that's...
You think the parents are working Monday morning at this time?
I mean, yeah.
I do. And I think that even if they aren't, they're expecting their kids to be home and they're trying to figure out exactly how they're going to plan their day. I'm just saying, theoretically, that might be what would be going through somebody's mind should they be a parent who have children who are remote schooling. Just theoretically, John.
I thought Monday mornings and Friday evenings were just the dead zone now, where nothing gets done. That's what the CEOs will tell you, that nothing happens Monday mornings and Friday evenings.
Is this
thought that
dead
was
zone?
true.
Is this dead
You
zone?
and I?
Yeah.
Might be for some people. Not you. Maybe me. Won't be now. Lisa Hornby's joining us from Schroders, head of US multi-sector fixed income. Lisa, great to catch up. Yields are low, low, low. Spreads are tight, tight, tight. And 2021, we've heard people say we can go a whole lot lower and a whole lot tighter. Do you agree with them, Lisa?
Well, I mean, first of all, good morning. Hopefully we're not in the dead zone. I think that yields probably are going to be fairly stable this year, or I guess 2021. Spreads, look, I think Lisa alluded to it earlier. It seems like right now the market is willing to look through almost every piece of bad news that comes out and just wants to, there's just constant buying, at least in the fixed income markets. I think that probably continues in the near term, although of course you have to be more cautious when valuations are starting to approach the levels that we're seeing. I mean, certainly the Fed's going to come this week and do everything they can to not upset the apple cart. So I think you have this environment for a while longer where you have negative real yields, which encourages risk asset buying. But certainly you have to be more selective in your spots this coming year.
Do you get the sense then that the test really begins at the start of Q2? That it's the data in that quarter, Lisa, that's going to be the beginning of the test for this market and not the data between now and then?
I think that's a fair assessment. I think people are really looking through the next couple of months because everyone expects the lockdown orders, the stay-at-home orders to do nothing but increase over this period of time. And so the data should deteriorate. The service side of the economy, which is still obviously weak and has never recovered, is going to probably get a little bit weaker before things start getting stronger and we have enough people vaccinated. But yeah, I think that's right. I think there's an expectation that by the time we get to the early spring, there'll be enough people vaccinated. Things will start to lift. Temperatures will be warmer, so the virus will start to recede on its own, just from a seasonal perspective. And that's where we really need to see things start to improve materially of economic momentum.
So,
and then,
well, I'm curious to know, everyone's talking about how the true test may be next year, the true test may be at the end of next year, and the true test being perhaps defaults, the fact of perhaps companies being unable to pay their bills. But it seems like the Fed is willing to backstop markets indefinitely here. And it seems like if we get a vaccine, it will only get easier for companies to borrow. Are we going to just simply avoid default cycles altogether from here on out in the immediate future, Lisa?
I think that's fair. I mean, it's not just the Fed doing that, right? You look at what the ECB did a few days ago. I mean, recalibrating their policy packages to try and extend things beyond the scope of essentially COVID, right? Where they're now extending their programs to well into 2022. So I think you're right. Central banks and increasingly federal governments are trying to say, let's get through this really tough part and then we'll sort out the damage. And I think if you can get if you can get Congress this week to pass some kind of, or start at least getting closer to passing a fiscal package, it's going to just do that on the consumer front as well, right? More small business relief, more help in terms of unemployment insurance for individuals. Let's get through the rough part and then we'll sort out where we are and what's left to kind of pick up the pieces.
So I guess that, we have to start worrying then about zombies, about zombie companies, the idea of companies being kept alive. I don't want to say artificially, but artificially by fiscal and monetary policy and what the longer term consequences of that are. I mean, as an investor, does that mean invest in them, or does it mean that you have to recalibrate your assumptions around what growth is going to look like going forward?
Yeah, I mean, I think that's a great point, and that's not just something we're dealing with because of COVID, right? If you think about the low interest rate regime that we've been in for the last several years, zombification has been allowed to happen, and we're seeing more and more companies like that every day. For us, this means we want to look away from those types of companies. We want to look to companies that have positive cash flow momentum, that actually can grow and can generate some earnings going forward. You know, when we think about where there's still value, at least in the investment grade markets next year, it's companies that have the runway to get through the next few months that we're talking about being a bit challenging, but then should be well placed to benefit from the vaccine and the economic momentum expect to see next year. I mean, in all practical purposes, we do expect it to be a decent year from an economic perspective. So I don't think you have to be forced to buy these zombie issuers that, you know, potentially will have some challenges in the future. Potentially, if we have a higher rate environment at some point down the road, I don't think we need to get involved in those. I think there's other opportunities out there that look more attractive.
The rules of the game have just changed drastically in the last 10, 15 years. Lisa, I keep hearing this word distortion, where you twist something out of its natural state. That's the definition of distortion. But if you've had those distortions now for a decade and more, Lisa, isn't that just part of the natural state now, the fundamentals, and that we need to change our approach to markets, that sitting here with some kind of sort of moralistic judgment on how markets should be, I get it, helps people. It's like therapy. But, Lisa, it doesn't help you make money, does it?
I love that. I love that analogy. Is distortion just the new norm now? Yeah, I think that's probably true. I mean, I think we've all come to terms with the fact that we are in a negative real yield environment for the foreseeable future, and we have all come to terms with the fact that means something for risk assets, and we need to continue to find opportunities in markets despite this environment. I think that means that valuations potentially could compress to levels that we don't feel is necessarily justified just by the economic backdrop, or by the fact that leverage metrics are as high as they've been in many parts of the investment grade corporate space. But there's still going to be demand for this paper regardless, because there's just a price insensitive buyer in the market that's going to continue to be there for the next couple of years. And I think that generally means a supportive environment ahead of us. But again, you have to be more cautious when you look at valuations, and you have to be a little bit more thoughtful about where you're allocating your risk bullets.
Lisa, great to catch up, as always. My best to you and yours. Lisa Hornby there of Schroders. Lisa Abramowitz, that's been the story not just for the last year, but for the last 10 years, arguably. The rules of the game have just totally changed. And this year will go down as just a classic example of that.
So you think that saying that it's distorted is a measure of group therapy? I love that.
I think that we sit here on programs sometimes talking about distortions and how markets should be and where they should trade, but the market is ultimately the market. And for people who studied economics, post-grad economics, price-insensitive buyers in a large financial market, fixed income, equities in Japan, wasn't really anything that came up. That didn't come up in the conversations that you would have with your teachers, Lisa. And I just think that's the part of the story now. It's a feature now. It's part of the fundamentals, and people finding it really difficult to accept that. And by the way, rightfully so. I get it. But that's it now. You've got to kind of let it go.
Well, there's a question, at what point does it matter? Are there no negative consequences to this, and can you just keep betting on it? Coming up, Henrietta Trays, Veda Partners Director of Economic Policy. For our audience worldwide, equities up 31 on the S&P. We're up 0.8%. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Google says the vast majority of its widespread product outages today should now be resolved. Services including Gmail, YouTube, and Classroom were failing to load for users in New York, the UK, and across Europe. Google's search product was functioning normally, and third-party ads remained visible in results. Meanwhile, hospitals in the U.S. start getting the coronavirus vaccine today. Shipments began leaving Pfizer's Michigan factory yesterday. Over the next 3 days, the shots will arrive at more than 600 hospitals. The 2.9 million doses will first be given to healthcare workers and nursing home residents. Russian government hackers reportedly have hit several U.S. agencies. According to the Washington Post, the attacks targeted systems within the Treasury and Commerce Departments and other government agencies. The newspaper says the agencies were breached through the server of a network management system called SolarWinds. And members of the Electoral College meet today to officially elect Joe Biden. Some Republican lawmakers have said that would be the end of President Trump's attempts to overturn the results as far as they're concerned. Electors are committed to voting for the winner of the popular vote in each state. The president has said he'll continue with legal challenges. And he was a master of the spy thriller and defined the moral ambiguities of the Cold War between the Soviet Union and the West. British author John le Carré has died. He was once posted to Berlin in the 60s as an intelligent agent, and that city became the setting for his first bestseller, The Spy Who Came from the Cold. Le Carré followed that with novels such as Tinker Tailor Soldier Spy and Smiley's People. He was 89. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off.
Ladies and gentlemen, I'm going to put a stop on profit for Canadian dollar further to 127.440. Yeah. Okay. Okay. Yeah. Let's see. We're already £1,000 in profit.
Alongside Lisa Abramovich, I'm Jonathan Ferro. Tom Keene will be back with us tomorrow. Just want to whip through the price action just quickly. Bond yields were higher. The curve was steeper. Equities were drifting up as well. That story holds in the bond market, up about 3 or 4 basis points on 10s to 0.93%. In the equity market, we do fall off session highs. We're still positive by about 0.7%. Call it 26 points. Lisa Abramovich, just some reporting in the last 5 minutes or so from our team here at Bloomberg. Went on the market just a little bit.
Yeah, that technology giants that are deemed gatekeepers, quote unquote, by the European Union could face fines of up to 10% of their annual revenue if they unfairly favor their own services or don't comply with certain regulations. That would be the Facebooks and the Googles of the world, basically saying that if search results come back favoring their own products or their partners or some kind of financial benefit that they get, that they could get fined or otherwise forced to potentially even divest some of their businesses. You can see there's a bit of a reaction in markets with Google shares down just a little bit. But it's interesting to me, John, the European Union has been leading the way in this capacity. There is a question of whether other nations, particularly the United States, will get on board, given the fact that there does seem to be a wave of Democrats in Congress that could potentially also start increasing scrutiny on big tech.
So the fines could get bigger. This according to a draft of new regulations seen by the team here at Bloomberg News. Great guest to catch up with just to get a reaction to this. Henrietta Trays joins us now, Beta Partners Director of Economic Policy. Henrietta, we'll get your first take and then we'll talk about what we could see in Washington. This is the European story. What's your reaction on our reporting at the moment, Henrietta?
I think the interesting piece is to consider that Democrats and Republicans both clearly want to have a broader conversation about tech, but one of the pieces that unites them almost unanimously is whenever the European Union decides they want to tax any of our big businesses in the tech space. And so it is a fight almost to the finish line to see whether we can complete a digital tax negotiation first, whose regulations should be adhered to. The U.S. generally perceives the European Union's regulations to be overly burdensome, biased against the United States corporations, and effectively a land grab for dollars from the tech in the United States sector. So it is a unifying moment, one that the trade negotiators are going to have to deal with, just as the Senate Finance and Ways and Means Committees are going to have to deal with.
Well, Henrietta, do you think this one single focal point could divide efforts elsewhere? Do you think this one point could divide efforts elsewhere?
I don't think so. I think you have to view all the tech issues holistically when you're talking about taxation or fines or regulations and who needs to adhere to what. I think the tech space wants to see some pushback from the United States and buying time because they know that, you know, the end of the road is going to come and they are going to see more fines and taxes generally, but they're trying to both stall and reduce the overall scale of any regulatory or taxation components to the best extent that they can, but they know they're on borrowed time.
Yeah, meanwhile, before we even talk about additional taxes or other measures in 2021, we've got to get through the rest of this year and the fiscal support package that's currently in Washington, D.C. Based on your conversations with people in the Beltway, what's your sense of what could and will get passed?
Yeah, fair enough to talk about this year. I think we're looking at something in the range of about $600 billion, maybe $700 billion at the high end. There are some proposals floating around, and we could see legislative text later today. There's substantial frustration with most of the Republican staff that I speak with about the lack of text from either the bipartisan group or real text around a McConnell plan or Treasury Secretary Mnuchin's plan. They just want to see something real, and that really gets to the heart of the problem. You cannot put out a deficit increasing nearly $1 trillion stimulus package 10 days out from a government funding deadline. You need to put this out at the 11th hour. I think tomorrow is going to be when we start to see some real action, but my expectation, and for our clients, it's roughly 75% odds, is that it's a matter of scale, not whether or not we'll see a stimulus bill. So somewhere in the $700 to $600 billion range is what I'm expecting. That's bare minimum unemployment insurance benefits, about $300 billion in recycled PPP and Fed Treasury lending programs, some funding for schools and healthcare providers, vaccines, testing, et cetera. some broadband aid, child care, but nothing in the line of a direct payment to individuals or a federal booster payment on the unemployment insurance benefit side. I describe odds there at like 30-40%. I think it's just too expensive.
So $600 billion to $700 billion. Currently, we're hearing that the bill is being broken into two different pieces, the $748 billion that is not including the $160 billion of state and local aid. Do you think that that's basically dead in the water, that financing for local governments?
I do. I think that they'll have to sort that out in 2021, and the same is true for the business liability pieces. They haven't been able to agree on any of those components since the CARES Act passed, and I don't think anything's meaningfully moved the needle or changed thus far. You have the dynamic of the two Georgia Senate seats up, and I think that the Republicans are anxious to, continue to be fiscally conservative, even as they pass deficit increasing finance legislation. And of course, the deficit has increased, I think, by threefold under the Trump administration. But it is a big issue for the base Republican voter in the state of Georgia. And so if you can keep spending down, especially on the state and local side that they think disproportionately benefits coastal states, which are mostly Democratic, then they would prefer to see that. So keeping state and local out of this is probably a necessity, somewhere below 160 for sure.
So in many ways, this is just about Leader McConnell setting us up for January 5th, Henrietta.
I think so, yeah. You're not going to be able to see a $1.2 trillion package come out and then say that you're fiscally conservative. It's just incongruous for the senators who are running there on a fiscally conservative bias or basis. The concern in Georgia is mostly within the Republican conference. Are we going to see 5 to 7% of those voters boycott the election as a result of the outcome of the November 3rd election? How can we turn out the Republican base? How do we make sure those voters come out and it's not just a deluge of Democratic supporters for Ossoff and Warnock? So they do hew towards that fiscal conservatism, which has to keep your spending below $700 billion to get to the Senate, in my estimation.
Henrietta, great to catch up, as always. Stay well. It's wonderful to hear from you. Send our best to you and yours. Henrietta Trays there of Vader Partners. Lisa, let's talk about this.
Shall we?
Fiscal conservatism in 2020. This is not me advocating for anything. Let me just put that out there. First and foremost, it's not $1 trillion anymore, but $500 billion, you are still fiscally conservative. And I think it's worth recognizing, and we've talked about this a few times on this program, just how much this year has changed our view of what being a fiscal hawk actually is down in Washington, D.C. That's just how phenomenal this year has been for all the wrong reasons.
Yeah, although I will say this, that there are no economists, absolutely no one, who says at this point it is time to save and pay back debt when you've got borrowing costs this low. I mean, honestly, have you heard anyone say that?
I'll find you a few.
Will you?
I'll find you a few.
All right, that's a dare.
All right, give me like 2 minutes. I'll find you one.
Okay.
Laura Rame isn't one. FS Investment's chief economist. She'll be joining us shortly. Right here on Bloomberg. This is Bloomberg TV and Radio.
Well, the main instruments on board include a dual-frequency radar altimeter. And this is the primary instrument of the mission, and that's the one that's measuring sea surface height, significant wave height, and wind speed over the ocean. And from those measurements, we can actually have the superb measurements that we expect of sea level rise, but also the waves. The significant wave height, which is the top 1/3 of the waves, if you were to look at them in time.
Sea level rise is accelerating, and it is not geographically uniform. In some regions, the rate of rise is 2 to 3 times faster than the global mean. This means that in this region, the elevation since the beginning of the 90s is now nearly 30 centimeters, which is not negligible.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
From New York and London, for our audience worldwide, good morning to you all on Bloomberg TV and radio. This is Bloomberg Surveillance, and here's some of the price action for you this Monday morning. Coming into Monday, we're positive. About an hour away from the opening, about up 27 points on the S&P 500. We advance about 0.75%. The wonderful Lou Wang at Bloomberg News just breaking down the numbers. Year-end 2021, the average forecast of the people that we track, 40.35, right now 36.80 on the S&P 500. 40.35 is the year-end call from the strategists, consensus view from the strategists on Wall Street. Coming into 2020, that number, I said it about 90 minutes ago, that number was 32.80. That was before anyone really knew about COVID-19, before anyone even knew that the global economy would essentially be in recession. 32.80 was the call on the S&P 500. We saw 3,700 last week. Switch up the board. I finish on the bond market for you. Yields higher. The curve just a little bit steeper this Monday morning, going into a really key week from the Federal Reserve and the economic data as well. Yields up about 3 or 4 basis points on 10s, up 5 basis points on a 30 to 168, to about 93 basis points on a US 10-year. We get claims Thursday morning. They've been moving in the wrong direction the last couple of weeks. We get retail sales Wednesday morning. Is that going to start to move in the wrong direction? And we get the Federal Reserve, which for this market right here, in this bond market, is just absolutely massive. For yields to go higher, for this curve to steepen, they need to get out of the way in the minds of many people. And that's what we'll be looking for this Wednesday in the news conference with Michael McKee. We'll be wondering whether they do get out of the way, whether they offer any clarity on that asset purchase program. And you wanted a name, Lisa, a name, a fiscal hawk. Stephen Moore, of course. Stephen Moore.
All right.
Well, more, of course.
All right. We'll call him. We'll ask him whether he agrees that there should be no more spending whatsoever at this point. Based
maybe
on
he does.
Maybe he does. I think we need to check in. We'll do some surveillance research. In the meantime, let's pick up, John, what you were saying about the important week ahead with the Federal Reserve, the questions about what they'll do with their bond purchase program. Mike McKee covering all of it, asking the hard questions at those Fed conferences. Bloomberg International Economics and Policy correspondent. Mike, what is the consensus expectation from the Fed this week?
You know, it's kind of funny, Lisa. There isn't a real consensus. Market participants generally divide divided over whether the Fed is going to take action or not. The best guess, certainly there's nobody who thinks they will change interest rates, but the best guess is about 55% think that they will attach some additional forward guidance to their statement this time, suggesting that the pace of QE purchases will depend on the economy, depend on unemployment and inflation, rather than say they will keep it unchanged for the next few months. The idea that they may change the weighted average maturity, go out farther on the curve and buy, doesn't get as much support for this meeting. About 77% of the economists we surveyed say they'll do it sometime in 2021, but not at the December 16th meeting.
Do you think, Mike, that state contingent guidance on an asset purchase program is a little bit harder to do than it is with interest rates?
It's a little bit harder to do, but the point that they want to make, or what they want to get across to Wall Street, is that they are not going to be moving rates anytime soon, and this just pushes the idea out of QE infinity in the next few years, because nobody thinks we're going to get unemployment down to 3.5% or inflation up to 2.5% in the next 2 years, maybe. So the idea is to, without exactly putting a time frame on it, push it out to a couple of years from now.
Well, that's my question, Mike, why they wouldn't just choose a time frame, do time contingent guidance in the same way that the ECB has. So we've got several central banks doing different things at the moment. We've got Japan and Australia just picking a point on the yield curve and saying we're going to sit on it. We've got the time contingent guidance from the ECB saying we'll be in this market, max flexibility, this is the size of the package, we'll use this going out to March 2021. Mike, what do you think is behind the different approaches from the different central banks we're seeing at the moment with their respective asset purchase programs?
Well, they use their asset purchase programs a little bit differently in each of the various regions, but the biggest difference may be that the Fed has completed its review of how they do things, and they've decided that they're going to be inflation contingent in particular and not move until inflation rises above 2% for a significant period of time. So therefore, putting a time frame on it doesn't help, because if you haven't made it by then, or if you, for some reason, make it early, then you've got to go back on what you've said. If you tie it to the contingency, then you can wait until it actually happens.
Michael McKee, always great to get the clarity from you, sir, and looking forward to the news conference this coming Wednesday. Joining us now is Lara Raim, FS Investments Chief Economist. Lara, if you could build on that, that would be fantastic. What are you looking for this Wednesday?
Yeah, so I agree. I think, they've talked about wanting to do something fairly soon. I think they are going to try to be more specific about locking in those forward expectations of continued financial market support and economic support. I think something that we really forget is, if we look back at prior expansions, we don't know when this recession is going to end. But if you kind of look back, 1991, 2001, the Fed was actively cutting interest rates in the first 18 months of those expansions. Like, they are really used to actively supporting an economy as we're coming out of a recession. And I don't think it's not a coincidence if you look back in 2009, interest rates were at zero, puts them in a sticky spot where they can't really, do that traditional support. So the most active quantitative easing that we really got was 2011 and 2013. Like, that is just a sign of how, years into the expansion, they were still having to support our economy. So I really think, obviously, very different recessions, very different expansions, I would expect. But the point is that they are really gearing markets up for the idea that they are going to have to be accommodating them for years to come. And I think Mike's point is important. Markets love to look for a change. They love to be forward-looking. And, they're not worried about changing expectations right now of a rate hike. They're worried about those 5-year forward expectations, and any kind of yield curve steepening, they want to make sure to sit on that.
Laura, this is a really important point, the idea that the Fed has run out of a lot of ammunition, given where rates are, given how much money has already been pumped into the system by their monetary policies. Are you suggesting that based on where they are, based on their ammunition, they're not being easy enough, that they're not necessarily increasing their purchases enough to support the expansion as they have in the past, just based on where we are and how receptive the market is to their measures?
Lisa, that's a tricky question, because it goes both ways. Like, what more can they do? I mean, I think they have actively said they're all really squawking when Mnuchin's trying to shut down the Main Street lending facility. I think they would acknowledge that they want to do more and that they really are upset that some of those pathways to impact the economy directly might be taken away. I think they feel very comfortable that they can help financial conditions. The question is what that's really doing for the Main Street economy. So I think that's really the issue. But absolutely, I think they will argue that they need to be doing more, they want to be doing more, and that, as to your point, they've kind of run out of traditional mechanisms. So, how creative can they get? They are really pushing the envelope here.
In the meantime, you were flicking at the economy and the hurt that's currently out there. We're going to be getting retail sales later this week, as John was talking about, and the unemployment filings as well on Thursday. What are you looking for? How close are we to a double dip versus the expansion that people are already pricing in?
I think we're pretty close. And again, that's not atypical during, longer downturns that we get, some quarters that rise, some quarters fall. I certainly don't think it's going to be another Q2. But, think about, we're so used to looking at seasonally adjusted data. We forget that when it's not seasonally adjusted, so much spending activity and hiring takes place in this holiday period. So we're already seeing claims move in the other direction. We're seeing, we've already seen auto sales down in November. So I think we're going to see a decline in November retail sales. And December, I think, you can really get some pain just inflicted upon the fact that normally seasonal hiring is, plus 5 million in December when it comes to, retail facilities and holiday shopping. So the December numbers could, just because of technical reasons, look pretty ugly. So I think it's, whether quarterly GDP, you end up splitting it across 2 quarters, you don't actually get into negative territory. We have a resilient consumer, resilient businesses. That's the best that we can hope for to power us through what I think is really a tricky time for the economy. But when you look at hiring, you're seeing those permanent layoffs increase. I think that's going to be a concern going forward.
Laura, you mentioned retail sales. A negative print may be on Wednesday. A lot of people agree with you. We're looking for negative 0.3% month on month on the headline number. Claims the day after. You mentioned claims as well. Claims have been moving in the wrong direction the last couple of weeks, as you say. Laura, claims haven't exactly given you a clear read on where payrolls might go because there's just been this massive churn in the U.S. economy. How useful do you think that is as an indicator for what's happening in this economy right now?
I think I always call initial claims the canary in the coal mine. I feel like the direction that it takes, how fast it moves, really has enormous predictive power. But it has been very hard, and it's really stymied a lot of us because you can't draw claims in terms of just plugging in as an exogenous factor into your model to get the employment number has really weakened in that regard. So I still think it's important to watch claims. That number last week really confirmed what we expect, which is that, we've seen the mobility data shrinking a little bit. Whether or not communities are imposing lockdowns or whether people are just selecting to be to stay at home more, either way, we're seeing some slowdown in economic activity, in November and most likely in December. So I think claims are still a critical indicator, but it's just, to your point, it's making that monthly payroll forecast a lot more tricky because we're used to using that as a strong input, and it's kind of been all over the place.
Yeah. Laura, great to catch up to get your thoughts. Always appreciate your time. Laura Rain there, FS Investments Chief Economist. Lisa, the calls have come through regardless around claims and what it could mean for the December payrolls report. Economics here at Bloomberg Economics, Carl Riccadonna, looking for a negative print in the payrolls report. The whole team on the US side, off the back of claims moving in the wrong direction.
Yeah, and I'm wondering at what point bad news will still be considered good news with respect to getting a bigger fiscal support package, or whether at a certain point it will just be bad news.
Coming up on the Open, JetBlue Airways CEO Robin Hayes. Looking forward to this conversation. What is going on with the airline business? We'll do that in around about 30 minutes or so. Equity futures up 25 on the S&P. We advanced 0.7%. This is Bloomberg.
With the First Word News, I'm Karina Mitchell. Google now says that problems with its services such as Gmail, YouTube, and Classroom should be resolved for the vast majority of users. Earlier, users around the world were reporting outages. Google products were failing to load in the U.S. and Europe. In other news, healthcare workers and nursing home residents will be first in line when U.S. hospitals begin giving coronavirus vaccine shots. The first 2.9 million doses will arrive at more than 600 hospitals over the next 3 days. Pfizer is sending the vaccine in containers filled with dry ice to keep the formula at 94 degrees below 0 Fahrenheit. The European Union is taking aim at tech giants. The companies could face fines of up to 10% of their annual revenue if they unfairly favor their own services or don't comply with other regulations. That's according to a draft of new regulations seen by Bloomberg News. No companies were named, but the EU is looking at so-called gatekeepers with billions of dollars in revenue. Blackstone Group is increasing its bet on life sciences real estate. According to Dow Jones, the firm has agreed to pay almost $3.5 billion for a collection of buildings in Cambridge, Massachusetts market. Even before the coronavirus outbreak, Blackstone was one of the world's biggest investors in biotech lab space and other life sciences property. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Karina Mitchell. This is Bloomberg. Much more to come.
Generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Well, it's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
If you're playing Brexit in the currency markets, obviously the best place to play it against is against the dollar, because that stands aside. Don't wait for Christmas to shed all those excess pounds. Shed those pounds now, because this is not going to go well.
The pound at $1.34, up about 1.4%. Just the wonderful David Bloom, who I've missed dearly, independent currency strategist, formerly the head of FX at HSBC. Coming up a little bit later this morning on the Open, Citigroup Chief US Equity Strategist Tobias Levkovich. Citi, year-end 2021, at the bottom, 3,800. That's bottom of the pile of the strategists we survey. Lisa Abramowitz, 3,800 over at Citi, in line with the 3,800 at Bank of America as well.
Yeah, I'm interested to hear what he has to say. I'm still stuck on David Bloom's diet recommendations that have to also do with currency.
Shed those pounds.
Shed those pounds.
Shed those pounds.
Love it. Love the puns. Thank you so much, John. We'll be checking out that interview. One thing that's been catching a lot of people's attention over the past few months is the big question of whether the big cities are going to remain hubs for the financial world. The latest weighing in on this, Deutsche Bank, with the Financial Times reporting that they may move half of their 4,600 staffers that are based in New York City out of the city into other regional hubs. Sonali Basak has been covering the entire Wall Street story as Bloomberg's Wall Street reporter. Sonali, what is this story? What are the details so far that we know about Deutsche Bank's plans?
So there's no concrete plan right now, Lisa, but what we do know is that there is a concrete plan that once they move into the Time Warner Center next year, that they will create a lot more flexibility for their workers to work from home, work from other cities, and not just be in New York City all the time. Something that's remarkable is how fast some of these plans have really accelerated. Remember, Deutsche Bank, when they announced this move away from Wall Street to the Time Warner Center, they slashed their footprint in New York City by 30%. That was in 2018. So now you're really seeing them start to accelerate this move even more while staying committed to the city in a big way still.
Well, so this is what I wanted to ask Sonali, because the acceleration that you're talking about is different than wholesale changing up plans and deciding all of a sudden to move out of New York City. I mean, Deutsche Bank had been cutting the number of staff in the more expensive city. Also, Goldman Sachs, which we were talking about last week about, potentially creating a hub in Florida, also has been looking outside of New York. How much are these new plans versus pre-existing ones that, simply to use your word, have gotten accelerated?
A lot of these are new plans, Lisa, and you're seeing the big private equity firms and hedge funds also create a much bigger presence outside of New York in Florida, where taxes are lower, you have a little more sunshine and very business-friendly regulations. Now, to make this really work, you also have to make a lifestyle that works for them in those locations, better school systems, investment in those communities. So this is a lot of new plans. There are certainly a lot of new plans. There's the culture of Wall Street changing and saying not everybody needs to work from the same hub in Manhattan, and then also changes starting to come around in those other cities as well.
Is there the question of how much people are going to get paid? In other words, you can move to Omaha, but you're going to get paid 30% less?
That is a huge factor here for everybody. But remember, there's this dirty little secret on Wall Street, and it's that if firms start to move their base, then that takes care of a lot of these severance packages as well. We're seeing cuts at a lot of firms as well. So how much of this is just lowering the cost base versus paying people lower amounts other places versus also making their head counts smaller in certain areas as well? It's something we'll be trying to track very, very closely. The other interesting thing, Lisa, is that people are not just hiring from the Ivy Leagues anymore. They're finding more of a rationale to hire outside of these big cities, outside of Delaware, outside of Florida. And so that change in culture is significant as well.
Wait, there's a lot to unpack here. I want to talk about the cuts that you're talking about. Initially in the pandemic, there were staff cut freezes at a number of banks. Those have gotten lifted. How significant are some of these banks going to be cutting their staff? both in response to what they're seeing economically, but also because with the low interest rate environment, it's just hard. You have to really cut costs in order to be more profitable.
That's exactly right. And, you know, there's only two banks that we really know of, Morgan Stanley and Bank of America, that held strong to that we won't cut anybody this year kind of philosophy. But, you know, 1 month from now, Lisa, we will have big bank earnings, and you will see just again, over and over, how bloated the cost bases are for these big U.S. banks. There's a big demand to get those costs in line, even for the companies we haven't heard talk about that issue very much before.
Where are the cuts coming, Sonali?
Some of it will be headcount. A lot of it, as you know, will be real estate. Remember, you were saying, is it just about paying people lower? That's one thing. But it's also cheaper for these companies to operate out of different locations as well, saving money on leases. So there's a mix of things here. You hope it's not all in the headcount, but we will certainly see some in the headcount.
Just as sort of a reality check, though, there's one reason why the big cities have been magnets for the big financial hubs, and that's because they attract talent and they attract younger individuals, and that's been the tradition over decades and decades. The people that you talk to who want to go to Florida, I assuming, are the more senior executives. Is there a sense that the big cities will continue to attract younger talent and will continue to be reservoirs for that hiring pool?
Right now, the narrative is yes, but that concern that the older bankers won't be there to teach them. This is an apprenticeship model. So if you have one banker that's leading you from Florida and the younger banker in New York City, there's a big concern about this next generation of bankers. Now, that concern has existed for a while, but it's getting more severe as there are fewer chances to learn.
All right, and just can you give us a sense, Sonali, who do you think is going to be the next bank, just to put you on the spot, the next bank to announce that they're looking at a potential hub outside of New York?
Oh, wow. If I had to guess, the reason I would say JP Morgan is because you've heard Jamie Dimon joking about this for years, you know, in the New York Post this weekend, and I've heard this anecdote too. It's Jamie Dimon's complaint that his servers in Manhattan have this great view of the city and not even the people.
All right, Sonali Basak, thank you so much for that. A really interesting story. They got a lot of attention, clearly. There's been a narrative of an exodus from the big cities. The question is, when the pandemic ends, how much that narrative will be confirmed or perhaps put to bed. We will see. Right now, we are looking at markets that are enthusiastic about the prospect of both a vaccine getting rolled out in the United States for the first time, as well as this idea that perhaps there will be a package passed in Washington, D.C. You're looking at the S&P poised up, gaining even more, up 0.7%, 36.79. That's where we're at. The 10-year yield just a little bit higher, still very muted in terms of yields creeping higher, with the expectation the Fed will come in and expand their purchases 0.9229%, going out to 4 digits, considering that Tom Keene has his grip over how many digits we use. The euro gaining about 0.5% versus the dollar, and the VIX lower. Right now, we are looking at solid risk on. We also have Brexit. John tries not to talk about it, and yet perhaps we are dealing with a deadline that's kicked a little bit longer. Coming up today, we are looking at Tony Ressler. He will be joining Ares Management Executive Chairman. He will be joining later today. From New York and London, this is Bloomberg Surveillance.
It is possible we could have negative growth if this resurgence gets bad enough and mobility falls off enough.
We knew that things were going to slow down after the bounce back in the third quarter, and you're seeing that in the data now.
We're going to be well into 2021 before there's some sort of equilibrium that we achieve.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
From New York and London, for our audience worldwide, good morning, good morning. The countdown to the open starts right now with 30 minutes until the opening bell. We're set to add some weight to this one, up 27 on the S&P. We advanced 0.75%, and we begin with the big issue. The U.S. rolling out a vaccine as fiscal talks continue on Capitol Hill. FDA Commissioner Stephen Hahn giving Pfizer-BioNTech the official nod.
I am pleased to announce that late yesterday, the FDA authorized for emergency use the Pfizer-BioNTech COVID-19 vaccine. We applied our high standards of review in reviewing this product so that Americans can have trust and confidence that the vaccine meets FDA's rigorous standards for safety and effectiveness.
So the vaccination effort begins right now. The government's head of distribution laying out a potential timeline.
We will have immunized 100 million people by the first quarter of 2021. We need to have immunized about 75 or 80% of the U.S. population before herd immunity can really be established. We hope to reach that point between the month of May and the month of June.
With the economy likely facing disruption until then, economists are lining up to still hope for more fiscal aid. As talks continue down in Washington, D.C., Speaker Pelosi and Secretary Mnuchin planning to resume discussions later today as a bipartisan group of lawmakers prepares to unveil a new two-part proposal. One part just including liability protections as well as state and local aid. The other part including all other provisions, including aid for small businesses. Senator Manchin saying Congress is staying put until there's a deal.
The plan is alive and well, and there's no way that we're going to leave Washington without taking care of the emergency needs of our people. We were on the call all day yesterday. We get on the call again this afternoon to finish things up. We'll have a bill produced for the American people tomorrow, $908 billion.
Joining us now, the Bloomberg team, Kevin Cirilli and Kelly Lyons. Kevin, let's start with you, sir. 908, break it down for us.
Well, it's a two-part proposal, and that is a narrow path for both Republicans and Democrats to particularly play politics in terms of who will get the upper hand. This as, of course, millions of Americans in dire need of some fiscal stimulus. Let's take a look specifically at what's in the $748 billion proposal, which will include non-controversial spending such as aid for small businesses. Then there will likely be a separate proposal which includes the funding for state and local aid. So you have a situation where Senate Majority Leader Mitch McConnell could be able to provide the funding, Jonathan, that he has called for months now. That does not include the funding for state and local aid. This is a stare down between Leader McConnell and Speaker Pelosi. I'm told that Speaker Pelosi and Secretary Mnuchin will talk sometime later today, but the White House has largely been on the back burner, so to speak, in this triangulation of negotiations. It's really coming down to whether or not centrist Democrats will be able to break away from the progressive flank of their party to provide some of this stimulus. That's why someone like a Senator Joe Manchin of West Virginia is such a crucial voice, not only in this current negotiation, but also centrists will play a crucial role in the incoming administration as well.
Hey, Kevin, thank you. Always appreciate your time, sir. And as Kevin has said repeatedly through this morning so far, a vote for 748 likely means you don't get the 160. That'll be the calculation that Democrats will have to make potentially in the coming week or so. Kevin down in D.C. on the markets, at a market desk, is Kaylee Lyons. Hey, Kaylee.
Hey, John. Well, futures pointing to a higher open this morning, whether it's optimism on stimulus or potentially the fact that the day has finally come and the vaccine is beginning to roll out here in the U.S. after the approval of Pfizer's candidate over the weekend. Now, here's how this Herculean effort is going to play out over the coming days. Already, Pfizer has packed about 2.9 million doses of its vaccine in dry ice to keep it at low temperatures and begun shipping those out across the country. 145 sites will receive the first round of doses today. Another 425 sites will receive them on Tuesday and 66 sites on Wednesday. Those shots will go into the arms of healthcare workers and nursing home residents first, and they'll have to take a second dose about 3 weeks later. Now, as this rollout happens, Pfizer shares are higher by about 0.9% this morning, but Moderna, a bigger mover early on, John, up about 3.7%. Its own vaccine candidate uses a similar messenger RNA, and that could be approved by the end of this week. Operation Warp Speed saying that if that vaccine is authorized alongside Pfizer's, 40 million combined doses could be available by the end of this month, and then 80% of Americans could be vaccinated by this summer. So there is a light at the end of the tunnel, John, but the fact of the matter is we are still in the tunnel, and it is a long one. The U.S. has added more than 200,000 cases every day in December, and we are approaching a death toll of 300,000. As a result, you're seeing restrictions continue to tighten. Here in New York, for example, indoor dining is shutting down once again beginning today. 54% of restaurants here say they won't survive the next 6 months without fiscal aid. So it really underscores the need for relief, even with a vaccine here, John.
Kelly, thank you. That's the story with Kelly Lyons, the story with the pandemic. Right now on both sides of the Atlantic at the moment, tighter restrictions in various states across the United States, and in Europe, Germany heading back to a hard lockdown, and in London, set to go into the highest tier of restrictions as well. Chris Mayer of Ocean First Financial expects an extraordinary liquidity to drive a rapid recovery. He writes the following: the vast majority of our businesses and customers, consumers, are very well positioned to jumpstart the recovery as COVID clears in the coming months. They only require clarity regarding stimulus and significant fiscal strategies like taxation. Chris joins us now for more. Chris, if you could just build on that a little bit for us, I think it's really important. You still have some clients, some customers sitting on their hands as they look into 21.
Sure, John. Great to be with you. And, our clients are looking for opportunities to invest, but they need a little more clarity. They need to understand where to invest, how soon to invest, and in what degree. And I think there's a perception that the stimulus is kind of disconnected from the rest of the economy. It's not. And if you think about what we're going through today with the vaccine, we have a client that was part of the stimulus earlier in the year, PPP funding, that manufactures laboratory glass. They manufacture vaccine vials. They were involved in COVID testing. That is a small business, a great business, but they needed the support to be able to be here for the rest of us. So it's all connected. We need that stimulus.
I just wonder how much confidence has actually started to build over the last several months, Chris, and how much of a hit it could take. You came out early in this pandemic and offered some of your customers things like deferrals, payment holidays, etc., things that just became the norm for many banks, not just in the United States, but around the world. Chris, has that started to come back? Have you pared that back, and not just in the strong sectors, but across all sectors? Have you seen that improvement more broadly?
We've seen a very broad improvement, John. So, we were among the first banks in the country to offer forbearance, even a couple weeks before the CARES Act passed. At our peak, we had $1.6 billion worth of customers in forbearance. That is now down to less than 50 million, and we think it'll be essentially none by year end. So our customers have been adaptive, reactive. They have they've done wonderful things. But when we think about stimulus, there are three reasons we need to continue with this. First, we need a broad recovery. Second, we need to make sure that there's equity among those that are disenfranchised. There are folks that can't simply work from home and preserve their income. And then finally, I think if you think about the lifelines for these businesses that we're asking to close to protect the rest of us, it's not fair to ask a business to close and then to not support them.
Couldn't agree more. The other thing a bank like yourself needs, Chris, going into next year is some kind of hope that we get some kind of rate normalization sometime soon.
Absolutely.
Any reason to believe that could happen, Chris?
Well, look, I think that we're all focused on the recovery. The next few months are going to be critical for us to understand how much stimulus, where employment numbers go, kind of how the economy reacts. We're a long road from that kind of steady state where you'll be able to look long term, and that's going to impact rates more.
Just a final word from you, Chris, if you can, on the IPO market that we've seen in the last week. I'll talk about it more through the program. But Chris, it's been clear to me that not just investors have struggled to read this market, bankers have as well. Chris, what do you think explains what we saw last week?
Well, I think that you come back to that old adage on Wall Street, the animal spirits, right? And the IPO market is really just reflecting this pent-up demand, the hope that there will be a great deal of optimism and economic growth as we work through this. And they're picking winners and losers. So, the economy through COVID is going to change. Those digital companies are going to have even more advantages. So I think the market's getting ready for that post-COVID period, trying to pick winners and losers. There's a level of enthusiasm about where the economy will go post-COVID, and you're seeing all that reflected in the pricing. It's more about that, I think, than the technicals of those individual companies.
Chris, always wonderful to catch up with you, sir, and thanks for your contribution to this programme through the year. Happy holidays to you and yours. Chris Mayer there of Ocean First. I want to turn back to this market. Futures up 26, the final full trading week of the year. And we get off to a bright start for the equity bulls, up 0.7% at the market desk with your movers. Here's Abigail.
John, well, there certainly is optimism in the air as the vaccine for the COVID-19 virus does begin to ship here in the U.S. for distribution. And on this, not surprisingly, we have some of the vaccine-related stocks popping here ahead of the open. Pfizer is higher, as is Moderna. Actually, Pfizer has now skipped a little bit lower there. That is in the intraday look. In the pre-market, Pfizer is higher, as is Moderna. As for the shippers, UPS and Pfizer, of course, cargo planes and trucks with the first U.S. shipments of the coronavirus vaccine have fanned out from both FedEx and UPS hubs in Tennessee and Kentucky. Those shares are higher. As for technology, John, let's take a look at the likes of Alphabet along with some of the other stocks here. Alphabet just about flat on the news earlier that some of their services went down, now apparently restored. On the other hand, SolarWinds, the security company, technology company, plunging down 15%, and they protect government agencies. Of course, that technology has been hacked, so that stock is down. On the other hand, FireEye, we have up about 0.6%. So lots of movement ahead of the open. Never a dull day, John.
Abigail, thank you. We'll touch base with you in about 20 minutes. Coming up, the vaccine rollout fueling the reopening trade with travel stocks rebounding. More on the recovery and the outlook for air travel with the JetBlue CEO, Robin Hayes. That conversation just around the corner. For our audience worldwide, this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need is surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
We need
need to invest now. I mean, we're touch wood, we're going to be coming out of the health and economic crisis. The question is, what direction are we pointing our economies? We're going to point towards sustainable growth. The government has to start with the objective, fill in with the framing, and then candidly get out of the way so the private sector figures out where to go.
The former Bank of England governor and UN Special Envoy for Climate Change, Mark Carney, saying the COVID-19 pandemic is providing an opportunity to move economies towards sustainable growth models. JetBlue responding to the challenge, becoming the first airline to join the Climate Pledge, saying it's dedicated to reaching zero net carbon by 2040. The CEO, Robin Hayes, writing the following: "Now is the time to rebuild operations in more sustainable ways, such as adopting sustainable aviation fuel and setting clear strategies to reduce net aviation CO2 emissions." I'm pleased to say that Robin joins us now. Robin, great to catch up, sir, at a really difficult time for your industry, but I think we should start here because it's important. For many people, Robin, the answer here is we just fly less. We take out capacity because we've proven over the last 6 to 9 months we don't need it. What's the response from the airline industry, Robin?
Jonathan, thanks for having me on today. Well, I haven't met many people in the last 9 or 10 months who don't want to fly again. So I think, most of us are looking at the pandemic as a reason to avoid flying for the short term, but certainly longer term, the need is going to be there. And so the question is, how do we grow in a sustainable way, making sure that our industry can contribute fully in navigating the planet through the climate crisis? And I think restricting aviation, making aviation only available to the rich and wealthy isn't the right way to be thinking about it.
What is the right way then, Robin?
Well, we have to reduce, our carbon footprint, and that's why we made the commitment that we did. It's about the development of sustainable aviation fuels, which I think have huge promise in the industry. It's more fuel-efficient engines, of which we're investing billions of dollars in new airplanes. We are moving our ground equipment over to electric ground equipment. We've already done that here at our main base of operations in New York. It's about more efficient air traffic control procedures, so we aren't flying airplanes around in circles around airports. And the amount of carbon an airplane will emit is much lower at lower altitudes than higher altitudes. And so things like better air traffic control procedures can make a real difference. And it's about offsetting where we can't, because it is going to take some time for some of this technology to catch up.
For anyone flying New York into Heathrow, or for that matter, Robin, anyone flying into Heathrow, they're used to that circle. You go round and you go round for 40 minutes. Waiting to land. People haven't missed that, Robin. As you point out, though, many people have missed travelling. And what we've experienced in the last several months is that leisure has returned first. Leisure first. This idea that business comes second. Robin, has your strategy around the business traveller changed at all after the experience of the last 6 to 9 months, or is it as you were?
Well, we are, for JetBlue, we're about 80% leisure, 20% business. So we've always skewed more heavily to the leisure sector. I completely agree with what you said, Jonathan. I mean, our view is that leisure has already started coming back and will continue to do so. I think a lot has been written about business travel and what happens. And look, I certainly believe that there will be companies that have learned to do business in different ways. And I think it will be some time, maybe several years, before business travel returns fully. But we also think there'll be a proportion of business travel that will come back in the next 1 to 2 years. There are certain types of industry, whether it's sales, distribution, logistics, where people really do need to travel, and those sorts of sectors we think will come back. But for us, what we've done is we've pivoted a significant amount of our business travel capacity, and we're flying to new leisure markets. In fact, during this pandemic, we've announced service over 60 new leisure markets. And so I think we've demonstrated that we need to be nimble during a time like this.
Do you think you remain nimble, or Robin, does that become a permanent shift? I mean, I should put it out there that I was once the business traveller with you guys in your Mint offering. I'm a Mosaic member, fully signed up. LA, New York, LA, in Mint. It was fantastic, and I enjoyed every single ride. And I put that out there so everybody knows, full transparency. Robin, going forward, though, I don't think the boss is going to send me out on as many trips over the next several years. And I wonder whether that skew towards leisure, Robin, is something that that sticks, just how sticky that is?
Well, I think he will be sending you out, Jonathan, because we're also going to be starting flights between New York and London next year. And so hopefully we'll see you on that, even if we don't see so much of you on our LAX flights. But no, look, I think there is going to be some shift in business travel, but we also don't fully understand some of the new markets that may be created. So, for example, if we are really going to have a lot more people who are working from home, working remote, that companies are okay if they're working in other parts of the country, there's going to be, I'm sure, organizations are still going to want to get people together once or twice a year. So that's going to create new markets in travel that perhaps aren't there today. So I think before we write off business travel, let's see what plays out. But what JetBlue is doing is we're continuing to pivot more of our capacity to leisure, people vacationing, people visiting friends and family, where we actually think there's pent-up demand in 2021. We think that a lot of people have put off trips this year. They're not going to put off going to see family for much longer, so they're going to travel in 2021, and we need to make sure that we're there to serve them when they do.
Have you started to see the cancellations pick up again in December, Robin?
We saw a little bit of a pickup ahead of the Thanksgiving holiday, Thanksgiving was still relatively strong. We still had a significant number of people flying. I think for several days, U.S. airports were over 1 million passengers for the first time. We've seen that elevated level of cancellations run through to December, but for example, the last 2 weeks of December, we're expecting to fly 2/3 of our normal schedule, which I think shows you there's still some in demand in flying. We're seeing quite a bit of interest in beach markets and people wanting to take vacations over the holiday.
The sweet spot for bookings, usually the start of the new year, looking ahead to the Easter period, to spring, looking ahead to the summer as well, Robin. Just give me a read on bookings right now from November into December, what that month-on-month sequential outlook actually looks like.
Yeah, so, I talked about the last 2 weeks of December where capacity we're expecting to be about 33, so about a third down of what we normally fly. January, we're expecting capacity to be about 45% down. Obviously, January, there's not so much of a holiday period in January. What we are seeing, though, is quite a bit of interest in booking vacations. So our vacations company has actually seen quite strong demand into the second quarter of next year. And January is normally a very busy period for people booking vacations into the spring and summer. And so we are actually expecting a relatively strong January for bookings further into the year. We think for January and February, travel may still stay suppressed.
This, of course, will have consequences for cash burn and how much aid this industry needs, Robin. Have you been speaking to the administration, to government recently, and where are we?
Oh, look, I'm going to say what most other Americans have said. We need a stimulus bill. The country needs a stimulus bill. It's not just airlines. I heard you, before I came on the show, talking about restaurant workers right here in New York City. Indoor dining closes down again. People need help. And I think it's very important that members of Congress know that, and they don't leave for the holidays until they've taken care of business and they've delivered the American people a relief bill.
I'll ask you a little bit of a tricky question. I caught up with the administration a couple of weeks ago, and their view was that they didn't want to offer aid to states that they said, quote, were poorly managed. And I always thought that that was somewhat inconsistent, because you could apply that thinking to certain parts of the airline industry, that maybe they've been poorly managed for not saving for a, quote, rainy day nobody expected. Robin, with that in mind, what's the argument at the moment? And I ask this with the best of intentions. From your perspective, the argument at the moment that this airline industry needs more aid and should get it.
Well, the aid for the airline industry since the beginning has been about protecting jobs. All of the airlines in the US that got assistance, and we were very grateful for it, were able to protect jobs. As soon as that aid stopped at the end of September, you saw a significant number of furloughs in the industry. People getting furloughed is creating a lot of uncertainty for them and their families, and they're claiming unemployment benefit and other benefits in any case. And so the CARES Act was really about keeping people on the payroll. And I think just as we talked about restaurants, talked about other industry sectors, I think the difference now to the beginning of the pandemic, it's much clearer to all of us which particular sectors are the most impacted. The travel sector, whether it's airlines, hotels, restaurants, theme parks, contribute significantly to our GDP. They contribute significantly to jobs. And so the need to protect these sectors so that they're there when people want to start flying again next year, I think is really important.
Robin, great to get you on the programme. Appreciate your time, sir. Robin Hayes, JetBlue CEO. For our audience worldwide, this is Bloomberg. Here are the morning calls. Citi upgrading Clorox to a buy. The analyst expecting pandemic-related tailwinds to continue fueling stronger growth. Gordon Haskett downgrading Airbnb to underperform. The analyst citing valuation. And your third and final call from Cowen naming Amazon one of its best ideas for 21, expecting e-commerce to continue fueling elevated growth. They're the morning calls. The opening bell next.
Once it goes into this plant, it's heated up very quickly to 600 or so degrees. It basically carbon
their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
My good colleague Lou Wang pointing out that not once in 2 decades has the consensus been for a down year. The consensus going into 2021, 40-35. That's the average call of the strategists we track. The average call coming into this year, 32.80. We trade right now on futures at 36.78. Futures up 0.7%. What a year it's been. Small caps absolutely roaring to close out the back end of the year. 6 straight weeks of gains. Coming into a 7th maybe. Switch up the board. Get to the bond market. What a week we've got coming up for treasuries. The Fed, retail sales, jobless claims, yields higher, curve steeper. Up 2 basis points to 0.92%. In foreign exchange, euro stronger. Almost the highs of the year, just off them. 121.56 on euro dollar, up about 1/3 of 1%. And the crude recovery defined in the back end of this year too. $46 and about 90 cents on WTI. We advanced 0.75 of 1%. That's the cross-asset price action at the market desk with your movers. Here's Abigail.
John, there certainly is a bullish tone this morning. It's another Monday and more vaccine news. Of course, this is the real news, the news that Pfizer's vaccine is being shipped for distribution here in the U.S., 300,000 doses initially. Moderna is expected to have their vaccine given emergency authorization relatively soon for use this year. So we see those shares popping higher, again, setting that bullish tone. UPS is also nicely higher. They are a part of the shipment of the vaccine on their cargo planes. And McKesson, the medical distribution company, up about 0.8%. Some of their equipment, syringes and kits being used in the process as well. Now, on this optimism around the vaccine and the idea that it will help the overall situation return to normal, we have the reopening, the reflation trade in play. Take a look at some of the travel stocks, American Airlines along with Carnival Corp. The idea that folks will be willing and able to travel next year has those shares higher on the day. And we have Bank of America up about 1%, being helped out by the yield curve steepening, and Chevron, big oil, getting a bid as oil is higher, of course, on the hopes, John, that as the overall situation does improve, there's going to be more demand for oil, again, sending that energy sector higher, John.
Energy sector, top of the pile. Abigail, thank you. We advanced 1.3% on that sector. The S&P 500 up 0.6%. For Wall